Okay. Good morning, everybody. Welcome to the 2020 Nape Annual International Conference and Exhibition. My name is Abdul Latif Amodu. I'm currently the Publicity Secretary for the Nigerian Association of Petroleum Explorationists, and it's my singular honor to be your Master of Ceremony for today and invariably your moderator for today. Let me welcome you to the pre-conference workshop for the 38th Annual International Conference and also our 45th anniversary. It happens to be this year. As I welcome you to the pre-conference workshop. The theme of the conference for this year, for the pre-conference workshop for this year, is levers for optimal reduction in Nigerian oil and gas production, positioning for the new normal. I don't even need to tell you what the new normal is. We all are aware of the challenges, the myriad of challenges, the diversity of the issues plaguing the oil industry right now. The full value chain is under assault from the impact of COVID-19 pandemic, from significant low demand for energy, which invariably translates to a reduction in demand for hydrocarbons. So today we'll be exploring and looking at conversations through our keynote address that will be given to us by our sponsors, Seplat, and be presented by the Chief Executive Officer for Seplat, Mr. Roger Brown. And as we go through the day, we'll walk through a couple of panel discussions, and this will be led, prior to that will be led by, yes, so that's the agenda on the screen. It's a very, very simple agenda. We have the keynote address by Mr. Roger Brown, CEO of Seplat. Then we'll take a couple of presentations by Mr. Pedro Motumei, and then from FES, the GGM FES, Mr. Abdullahi Bomai, before we walk to the next break. Then we have next set of presentations before we lead into the panel conversation. At this point, it's important to share some general ground rules. The first is, as we go through these presentations, we believe they will start to hit one or two chords with you. Please kindly use the Q&A button, leverage the button to put in your questions. Behind the scenes, we have a team of repertoires whose job will be to synthesize these questions and ensure that we address them during our panel discussion later in the day. So please feel free, don't be shy, use the Q&A buttons. We would appreciate that. Next, I think I have the singular honor of introducing a fellow of Nape, our host for the day, Mr. Alex Nachi Taka, the current president of the Nigerian Association of Petroleum Explorationists. Mr. Alex.
Yeah,
Mr. President.
Amodu, I can start my video.
Okay, give it a second. It will be up and running.
Can you release my video? I can start my video.
Okay, noted. All right, so we can see you and we can hear you.
Thank you very much. Thank you very much, Amodu. Good morning, everyone present at this event. I'm delighted to present the President opening remarks at the pre-conference workshop of the 30th Annual International Conference and Exhibition, 16th of November, 2020, first virtual conference of Nape. I want to observe the protocols. I'm delighted and honored to welcome each and every one this year's pre-conference workshop, holding under the theme, levels for optimal cost reduction in Nigerian oil and gas production, positioning for a new normal, which we're in and have been in for some time. This is the first time in the 45 years history of our great association that we will be hosting our pre-conference workshop on a virtual platform. This is so courtesy of the times we live that many now call the new normal. I would first of all like to extend a warm welcome to all our invited guests and delegates who are connecting to this workshop from all over the world. I would also like to express my gratitude to all our esteemed speakers and panelists, whom I'm persuaded their papers and deliberations will bring forth initiatives that will accelerate the growth of the oil and gas industry in particular, and the nation's economy in general. My appreciation and gratitude also go to members of the planning committee that put together this workshop. Ladies and gentlemen, you are truly appreciated. And finally, to Seplat, sponsors of this workshop, under this trying moment, for still standing by us. We owe you a debt of gratitude. Thank you for your consistent support. The COVID-19 pandemic has created an unprecedented global crisis that has caused regions, countries, sectors, companies, families, and individuals to adjust to a new way of working, doing business, living, and relating with each other. As long as a cure or a vaccine has not been found for COVID-19 pandemic, it is expedient that we adjust to the new normal. The adverse global economic conditions occasioned by the COVID-19 pandemic has negatively impacted the demand and price of crude oil for most of year 2020. This has come at a huge cost to the Nigerian economy, which is dependent on the oil and gas sector for most of government's revenue and over 90% of total export earnings. Estimates during the lockdown period suggested that Nigeria's gross domestic product suffered a 34.1% loss, amounting to $16.4 billion. The resurgence in coronavirus infections in Europe and the United States, which has resulted in the repositioning of some form of lockdowns by a number of countries, is a setback to the recovery of the world's economy. And this could have adverse ripple effects on the Nigerian economy as well, just as it did in the first wave. In 2019, the full industry showed that the unit operating costs for all tests of $10 per barrel, showing a performance above, with its current averaging between $9 and $22 per barrel. The high oil production cost is in oil price as a result of the impact of the coronavirus pandemic on the global oil market. To save the industry from the harsh effects of high oil production expenses, especially in the context of the coronavirus and oil price slump, it is imperative that there's a change of strategy that would, among other things, involve engaging a reduction in oil and gas production. And I believe this is achievable. Interestingly, at a roundtable meeting tagged Going for Growth 20.0, organized by the Central Bank of Nigeria in March this year, the group managing director of the NNPC, my group JMD, Malamele Kari, said, and I quote, "Today, the best of our production system is $15 to $17 a barrel. There are many countries whose cost of production is $30, and Nigeria is one of them. So when the price now goes to 22, and we are producing at 30, which means we're out of business." The NNPC Group Managing Director set the end of 2020 as deadline for attainment of $10 per barrel production cost benchmark. And I believe once again that this is achievable. Ladies and gentlemen, the objective of this workshop is to identify the challenges facing the Nigerian oil and gas industry in this dispensation of the new normal with regards to mitigating optimal operational costs and operating optimally in the face of plummeting oil prices and demand occasioned by the COVID-19 pandemic. At the end of this workshop, a communique of the proceedings will be issued and presented to the federal government as our expertise contribution towards the actualization of deadline for the attainment of $10 per barrel production cost benchmark. Distinguished ladies and entire delegates, ladies and gentlemen, here is wishing you a most productive time at this pre-conference workshop. Thank you for listening. Long live Nape, long live Lex Nachitaka, CPG, F. Nape President.
Thank you, Mr. President. Thank you, Mr. President. Excellent opening remarks, and I think that has set the tone for the conversation for today. Again, I see we have a lot more people come on and join our pre-conference workshop. Let me reinform you, this is the first virtual conference for the Nigerian Association of Petroleum Explorationists. According to our agenda, we have just heard the opening remarks by the President of the Nigerian Association of Petroleum Explorationists. The next set of items, according to our agenda, is that we're going to have the keynote address, which will be given to us by Mr. Roger Brown. Mr. Roger Brown is the Executive Director, the Chairman, CEO, Chief Executive Officer for Seplat Petroleum Development Company, and the Executive Director for the same. With his experiences in finance spanning over 2.5 decades, I believe he is the appropriate person to have a conversation on looking for opportunities to reduce costs as we go into this new normal. The title of his keynote address is the same as the topic and the theme for the pre-conference workshop: the levers for optimal cost reduction in Nigerian oil and gas production, positioning for the new normal. Mr. Roger resumed office as the Executive Director on the 1st of August, and I'm sure he came in right in the eye of the storm. So if there's anybody that is appropriately skilled to know how best we should wade through these challenges, I believe it's Mr. Roger. Mr. Roger, can you hear us?
Yes.
Okay, excellent. Again, let's thank Seplat for being our sponsor for today. And we hand over to you to give a keynote address. Welcome, Mr. Roger.
Thank you very much. Good morning. Good morning, everyone. Good morning. First of all, I'd like to thank the president of Nape for his good opening remarks. Morning, ladies and gentlemen. It's a delight, an honor to be here. It's my first Nape conference or workshop. Obviously, previously, Austin Avuro was the CEO of Seplat, and he handed over to me obviously on the 1st of August. A very big supporter of this, of Nape, and obviously Seplat is, and I will continue with that same enthusiasm and support for a very important body within Nigeria. So thank you very much, and I'll just work my way through the slide deck. Hopefully we can have that presented. So obviously the the levers for optimal cost reduction, and I think the key thing here is optimal. There's no one way of doing cost reduction in dealing with the new norm, and hopefully it won't be the new normal at $40 oil, but we have to prepare and plan for that. So next slide, please. Okay, so this just in a snapshot. I mean, a lot of the audience here would be familiar for this, but I know this is going out live on YouTube, etc. So there'll be a number of new audience members, and it's well worth to sort of put oil and gas in the context of the Nigerian economy. And obviously, you can see there 37 billion of barrels of oil reserves. Actually, if you look at the gas reserves and in fact the gas resources, Nigeria has much bigger gas reserves and resources, and then it's been said before that it's really a gas province with pockets of oil, and I think that is going to be quite critical going forward. Is actually exploiting that gas potential. 2 million barrels of oil estimated daily oil production, and obviously today now with OPEC cuts and reductions, that's much lower than that. And then what does it mean in terms of tax take for the government? In 2019, it equated to 40% of the government's tax receipts and 65% of the government's revenues. But what's more important is that it's only, if you look at the bottom right, that it's only 10% of the GDP of the country. And so therefore, whilst oil and gas has a very big place to play within Nigeria, it's not the only contributor to GDP, but it is, as the president highlighted, a very big source of foreign exchange coming into the country. And that's one area that I think needs to be worked on in terms of the rebalancing. And then you can see daily gas production of 7.1 BCF per gas. So these are just estimates, but I think it really captures where oil and gas sits within the Nigerian economy. Next slide, please. Okay, so running through just where's the realities today, and we have 6 points to make on this slide. If you look on the first one, which is the oil price, obviously doesn't need to say that oil price has fallen quite dramatically. Q2 we saw probably the worst we've ever seen, and particularly it was negative in America. We saw cargoes getting lifted out of the terminals in Nigeria at sub $10 a barrel. But luckily we saw a bit of recovery in the end of Q2, and into Q3 we're sitting around the $40 oil range. So with the twin shock of COVID-19 still exists, and the Russian Saudi price war seems to have sort of stabilized. At the same time, you have oil demand falling, and OPEC cuts, cut forecast by about almost 10 million barrels a day on the threat of a second wave. And you can see that in terms of if you look at the bottom chart, bottom left, this is the Brent forward curve. And if you can look there, you can see the yellow, which is the very bottom, and which is the April 2020 curve. And for anyone who's familiar with this, obviously this is a contango curve, so the front end of the curve is lower than in terms of oil price than the back end of the curve, and largely due to that's either an oversupply in the front end or lack of demand. And of course, it's lack of demand in April. You start to see then in the July, which is the red, a recovery, quite a sharp recovery at the front end. And then you can see the blue there, which is the October 2020. So where we are today is we were in July hoping for a faster recovery, but obviously with second waves, etc., and COVID, and a soft market, then we can see there that the long-term recovery is just about getting above 50. And of course, these curves move a lot, but you can see out to 2029, you can see a convergence in around a sort of probably a $5 to $6 spread between the two. So oil demand is rebalancing the oil markets is going to be very critical to see oil price, and until that happens, we could probably see a soft oil price. So as an industry, we are a price taker at the minute, and largely likely to continue into the future. And the top right there, the blue box, the oil production, of course, fell down by 22%. We're restricted in OPEC quotas due to price slumps, and of course that has a balance between demand and obviously price. And we're all seeing that across Nigeria as those OPEC cuts continue into Q4, and we don't know what's going to happen to 2021. CapEx, of course, is the first thing to get cut back on. And obviously, in terms of our longer term planning, we then have CapEx reductions. And of course, in oil, we have decline curve against the assets of the wells, and we have to keep spending CapEx to keep the production flat and growing. So that has a long term impact. And then you obviously see that we, in terms of to remain profitable, there's a big cost optimization drive, and I'm delighted that the government has really taken the lead in this. It really helps us in the industry to drive down those costs, and we'll talk about that in the next couple of slides. And then the debt burden, and obviously being a leveraged industry with this tough times, then the debt burden can often grow, and you can see that. So you turn the next slide already. Okay, so on the next slide, what we're then saying is, look, where do we sit? Nigeria, where does Nigeria sit in the world in terms of its cost of production? And you can see there that in the first bar chart, it's 2016 average production costs, and then obviously 2019, and you can see there the inflation effect on the cost base over those 2016 to 2019. And Iraq is the far left, and you can see Nigeria is the third highest at the minute at just less than $40 average. It's a total cost production, of course. This comes from, I think, PwC analysis in there, and you can see in the slide deck we've referenced that. So we've got one of the highest total cost of production per barrel, and this obviously gives us some hope that we have a long way to go, and we can actually there's lots of things we can do to reduce that cost. If you then look at the direct production costs and gross taxes, direct production costs was about 37%, and the gross taxes about 33%. So, almost a third for each of those, and 2/3 of the overall costs are in direct production and taxes. And then if you look at the overall cost of an average break-even price for major proposed projects in Nigeria, it's at $48 a barrel. Higher than Angola and Uganda, and a lot higher than other countries. So there's an area there we absolutely need to focus on, which is our break-even costs, etc., for new projects. So we've had a lot of cost creep over the last 3 years. Next slide. Okay, so let's just then look at the four main cost drivers in the industry. Looking at capital costs, I've talked around that. We estimate that Nigeria projects cost on average almost 70% more than the global average. So our projects are obviously more costly, they take longer. And again, that's one area that absolutely can be focused on. OPTS identified a capital cost premium of between 35% and 100% for project costs in Nigeria. So not only are they taking longer and higher costs, but there's a premium to operating in this postcode or zip code, if you want to look at it that way. But it's one area that we absolutely have to work together as a group to drive down that, and that's a lot to do with in terms of disclosure and demystifying and saying, look, the risks in Nigeria, whilst perceived, are actually not as bad as people think. But that risk premium obviously impacts the cost base. Delays exponentially increase the capital costs, budget overruns, rig rates going up, etc. And that's one area that each and every oil company player in the market can control and can see that. In terms of drilling costs, are we getting the best? Obviously, the rig drilling in country is been not in certain aspects not that active over the years, and therefore maybe we're not getting enough rigs in country and the best pricing for those rigs. Then the next one is the financing costs. Looking at what does it cost to actually fund the industry, and we are generally more highly leveraged. And that is because a lot of particularly in the indigenous independents that we're one of, there's a lot of money is being borrowed to buy the assets in the first place, and then obviously that more money needs to be spent to grow and spend money in capex to grow production. So financing costs have been a big burden. A per barrel cost of funds are a significant cost item, and I think that's one area, obviously you'll see cost of debt for independents in the bottom there is circa 10% and even higher, which is much higher than obviously the major oil companies and actually higher than other oil companies globally. So all these, factors put into a competitiveness we have of Nigeria in a global context. And then the independents are responsible for about 90% of the $8 billion of debts owed by the oil companies. And again, that is a very high cost burden, which impacts the overall cost delivery for us. If you go to the top right and the production costs, again, we've said this before, but operating cost premium in Nigeria of 15 to 65%. And one of the big areas around that obviously is the shipment costs, the transport costs and the pipelines, water handling costs are on average $3.50 per barrel of wet crude and $2.80 for dry crude. And barging is much higher. We've seen barging and trucking costs up to $25 a barrel. This is, very difficult to make this work long term at those levels of cost. So the overall drive down in pipeline charges, losses are a big thing to it, and whether it be downtime losses, the pipelines out of action, or reconciliation losses with theft, etc., and other forms of loss there. That all has, a massive impact. If you're saying onshore between in some cases 30 to 40 and some cases 50% downtime and losses in the pipelines, of course, then your denominator in your overall cost base per barrel, means that your unit cost is a lot higher. You get that production out to market, and assuming we get a rebalancing of OPEC, then you can actually see a driving down there of the unit cost. And that's something that needs to be worked on. Security around the pipelines, etc., is very key. And then the last one on this page is administrative costs. And again, in terms of duplication, oversight, overlap of regulatory bodies, levies, fees, taxes, prolonged approval processes, and time is one of the biggest cost items. Time and delays in trying to get things approved. That's one area that the government can really help with us, with the regulatory bodies, to really make, look at the processes, try to simplify them, automate them as much as possible, and actually give big support in us trying to get these approved. And then you can see that in the contracting life cycle in Nigeria, takes up to, on average, about 36 months, whereas other countries between 6 to 8 months. And that time implication is enormous. So cost reduction needs to be sustainable. And you get this sort of boom bust of oil prices come up, costs go up, oil prices come down, everyone tries to cut costs. That on a cycle basis is very inefficient, and we need to work carefully as a value chain with our suppliers, contractors, government partners, etc., to actually make that a lot smoother so we don't get these big cycles. Next slide, please. Okay, so in terms of the Nigerian energy industry response, and again, I said this earlier, when the government came out and made these statements, really helped us as oil players in the country in terms of cost reduction, allowed us to work with our suppliers, etc., contractors, and really drive down those cost base. So the first one there on the left, cost control and management. Very critical is a real focus on cost optimization. Getting the below the $10 a barrel, in Seplat, in our case, we have certain assets are below $10 a barrel and other ones not. So again, with the federal government mandate is to drive down this. It takes time. It's important to set timelines on it, but make sure they're realistic. And we really need to drive that down, which is a focus. So if everyone every day understands the cost of everything, a delay cost, and we try to quantify that, then we can then look at driving down crude handling costs is a very big part of that $10 a barrel. And if you're looking at $5 a barrel, get your oil from your fields out to the loading the vessel, and that's even before losses. But if you factor losses in, you're up to $8-9 a barrel with a loss factored in onshore. That's a big part of that $10 a barrel. So again, looking at efficiency of pipelines, terminals, etc. Looking then at portfolios and optimization and asset rationalization, just going after any asset, drilling any well, we need to look at our portfolios, rationalize them, look at which wells give us the best return, which ones are uneconomic, and then targeting those wells that are the best in this low oil price environment. And look, it's likely the oil will go up and down. So at $40 oil, hopefully we're not looking at that going forward. And maybe it goes back to 50 and 60. There's an ability to drill some of those other wells in a higher oil price environment. But we need to look at our portfolios critically and actually target it on the best wells, again, reducing cost. And then the top right, there's operational excellence and compliance. So really looking at, are we doing things the most efficient? Have we got vertical integration right? From wellhead right through to end consumer, particularly with a lot of oil in the future, with the new refineries coming on stream in the next year or two. A lot of oil will be refined in country, and I think that's got to be a good solution for Nigeria. Having a lot of crude oil exported and refined product imported, the spread differential between there in terms of cost all impacts the industry. So looking at vertical integration, operational excellence, compliance, looking at new techniques, and we're going to get into that in the next slide or whatever, but in terms of how that is driven through, is critical. And then partnerships. This is the collaboration element to it. If we collaborate as an industry with our partners, with our suppliers, etc., and we're all clear in what we're trying to achieve, then we can obviously cut out a lot of wastage in time and excesses. So looking at shared risks, returns, business environment, and investment drive. And I'm delighted to say that the director of DPR came out and said, let's look at driving down these costs, but also let's look at gas, and gas is one area which is a great counterbalance to oil price. The gas prices are largely more controllable than the oil price, and that gas oil mix really works, particularly in the low oil price, in terms of ensuring the business continues. Next slide. Okay, so looking then at the strategies for survival and sustainability in a low oil price environment, and looking at 12 o'clock here on the clock. First of all, is technology, and this is one thing that as an industry globally, particularly if you compare it to other industries like automotive and other industries there, our technology harnessing is it could be a lot better. We can learn a lot from bringing in new AI techniques and automation, and really trying to finesse what we're trying to do. And that by using machines, smart technology, should again reduce a lot of our cost base and making sure that we're a lot more efficient, getting the right software in terms of how we balance chemicals, etc., how we drill out wells. It's very, very important. Going clockwise now, then we've touched on this before, capital efficiency, project screening, to ensure that dollar is going in and gets the right return, and there's a dollar in, how many dollars come out, and when does the dollars come out? Is it over 2 or 3 years, or is it over 10 years? Again, these have big impacts in terms of how efficient we're being with our capital. And so looking at short cycle returns, and dollar in, $3 out, $5 out is critical, because it's about then reinvesting those dollars in for growth. Cost optimization, we talked about elimination of waste, reduction of operating costs, and efficient project delivery within cost. That's critical here. At 6 o'clock here is really the collaboration. And I think this is one area where we're going to get some of the biggest cost savings and efficiencies, is really being clear with each other what our plans are, what our synergies are. Are there areas that we can save cost? We can use shared infrastructure, rig time, etc. Obviously, a rig sitting idle is not efficient, but if operators can then look at how rigs can be deployed efficiently across each of the operations, I think that is critical. The value chain, really looking at it and seeing where there is wastage, if there's bulk buying, whatever else. Let's look at that for better returns. Hedging, of course, is some mechanisms we can use to control price a little bit. Oil price hedging, and a lot of companies are active in that. I think the best way to control oil prices, you control your costs, but the hedging is often just a insurance policy to protect for the downside. And then portfolio diversification optimization. Again, this is bringing in gas. And when we're going to look at gas in a second, but gas is really one area where it's such a logical thing for Nigeria to advance into. It's a great balancer for oil price. It's much more efficient doing it, and obviously there are carbon benefits. There's lower carbon in gas than there is in oil, and particularly if we're displacing diesel in the country. So there are a lot of environmental benefits. There's a lot of stabilization for our businesses, and it's better for the Nigerian economy, because obviously gas is a naira-based hydrocarbon, where oil is a dollar-based hydrocarbon. And in a way, if we stop utilizing diesel in our generators in around the houses and the towns, the buildings, etc., and using gas, then there's foreign exchange benefits from that for the central bank. And it's one area that we as an industry should really start to develop and stop flaring for sure. So if we then go into the next slide, I've only got 2 slides left to cover this. So in terms of optimizing costs, and again, this is a little bit more of a deeper dive into it. So in terms of strategies, it's really looking at ways and means to adopt low cycle operating model, short cycle planning, but far enough ahead that we can plan for when we need, either in terms of materials or rigs, etc. Renegotiating contract rates, but giving our suppliers and contractors a very clear steer for the future and what our plans are, so they can see a business in it and they can make money. Water disposal, infield water disposal, particularly onshore. A lot of these assets are mature fields. There's a lot of water cut coming in at maybe 60, 70%. If that's going out through a pipeline at $5 a barrel, while investing in liquid treatment and reinjection, I think that is one area that we can reduce in the crude handling quite significantly. And then reserve production capacity at the terminals, more flexible collaboration, frequent reevaluation of that, particularly if you have an up and down production curve. That's very important. Capital efficiency, again, we've said this before, but it's reducing the contracting cycle is very important. Looking at really true break-even costs and reducing those. And Nigeria should be able to, we should be able to get our cost base down quite dramatically, and we should be very competitive in a global context. So we can actually, live and produce through low oil prices, which would be likely to come in the future. And then looking at third-party savings, cost savings. Again, we've quantified that at potentially, if you're looking at a range of third-party savings, we could get a 23% cost reduction. Top right, technology is absolutely critical, and again, that's been quantified that it's possible to generate annualized well cost savings up to $30 billion for upstream players by reducing operating costs 3 to 5% and capital costs by 20%. So technology, it's been utilized quite effectively, particularly in the shale gas and oil in the US, bringing in new technologies. It's one area that Nigeria can and will and need to drive in to bring new technologies in to our operating environment. And in collaboration, we've mentioned that before, it's just really to look at synergies. Certainly for and this is a plea for the independent sector, which is a very critical sector in Nigeria. And I'm not just talking of our own book here, but any oil province that doesn't expand and deliver its independent sector really struggles, I think, long term. So I'm delighted that we've actually been able to do that in the last 10 years. But again, the independent sector needs a lot of support from government. It needs help in having OPEC cuts and high tariffs, etc. We would like the government to look at further ways of supporting the indigenous sector, because ultimately that sector will drive through a lot of the efficiencies and give a longer term sustainability for the sector. Final slide, just some of our cost optimization strategies, just 5 of them here quickly. So again, with the government and others, we renegotiated our existing contract, and the target was at least 30% cost savings from suppliers. Suppliers were very open to it, but of course they wanted obviously the partnership long term. I think that's critical. In terms of standardization and upgrade of site cost tracking, cost estimation, I think we're all human beings. We don't know every day what things cost. If we can really quantify it, and so employees know that 6 months delay in that project is going to cost $30 million, or selecting one drilling technique over another could cost $5 million. I think when you quantify it and people know what it's costing, these delays or non-optimized decisions, I think that then drives human behavior, and we start to get a lot more efficiency. Use of technology in terms of the plant design management system, PDSM, intelligent wells, these are utilized around the world. We should bring them more and more into Nigeria. In situ water disposal, we talked about before, rather than exporting water, we should be re-injecting. And then obviously, a constant review, an idea on optimization of G&A costs, etc. It's very critical. So that just highlights some of the areas. I'm sure these will be debated long and hard today. So thank you very much, and I'll hand it back. Thank you.
Right, thank you very, very much. Okay, thank you very much. Again, an excellent keynote address by Mr. Roger Brown. I think you've been in the job long enough to stop calling you the new CEO. I think.
Thank you.
Now, clearly, these are tactics you are employing in your organization currently. But personally, what's the one key item you would like everybody to leave with before you leave?
Yeah, I think it's going back to this collaboration. As an industry, we're all in this industry together, and we don't always work as partners. We need to, particularly amongst the oil companies, and we're starting to see a lot more of that with the IPPG and OPTS. But as an industry, sharing information, sharing techniques, anything we find that saves money or is more cost optimization, we should share that. And then working with the government, again, the government, are true partners to us. And again, we have to help each other. We have to listen to each other. Everyone's got slightly different angles to things, but in reality is that collaboration, partnership, sharing information, and seeing ourselves as one industry. See, we're one industry in Nigeria in a global context. So we're doing ultimately 2 million barrels a day in Nigeria, not at the minute, but eventually. There's 100 million barrels in the world, right? So we are, a small percentage of the world's output. So why wouldn't we work together as a country and an industry within Nigeria in working how we place our hydrocarbons, whether oil or gas, into a global context? And that partnership is in an area we have to really work together. And I think over the past, we probably haven't worked as closely as maybe other provinces and other areas that I've seen around the world. So let's stick together. We're in Nigeria. We're producing oil together. Let's share. Let's help each other, because again, we are competing against a world demand.
Okay, I think well said. What's the one thing that keeps you awake, though? In addition to the entire issue, the pandemic with low oil prices, what's that one thing that keeps you awake?
I think, just obviously, most of the areas that keep any sort of CEO awake are things like health and safety, asset integrity, health and safety, shocks, and just making sure that we have our seatbelt firmly fastened. I mean, shocks happen, things happen in the world. We can't avoid that, but getting ready for it. So it's a mitigation and getting ready. But of course, areas, health and safety is absolutely critical. It's number one in an industry and what we're trying to achieve, keeping it safe for everyone. So that's one area that clearly, beyond shocks in the world and COVID and you name it, making sure that we have the risk mitigation in place, active work 24/7 for our company, that we can prepare and be prepared for any eventuality happens.
All right, thank you very much. Let me use this opportunity again to thank Seplat Petroleum Development Company for sponsoring the pre-conference workshop. I believe you set the notes and the tone for the conversation going forward. Again, we thank the Seplat brand and the Seplat company for their support of Nape activities. Do have a wonderful morning. We'll be taking a slight break right now. And after that slight break, we'll start to take our other guest speakers and presenters. All right, thank you.
Thank you.
Okay, thank you very much. I think it's important that we remember that we have the opportunity to put in our questions using the Q&A button. It's very important we start to do that. Clearly, the conversation has started, and thoughts and the deliberations will continue. Now, it's my honor to introduce from one accountant to another accountant, Mr. Pedro Omotumehi, who is currently country operations partner at PricewaterhouseCoopers, and the firm's African oil and gas leader with almost 30 years on 3 decades of experience in this field and acting in different advisory service position, tax, accounting, and building consultancy. Mr. Pedro is absolutely the right person for us to be talking to. He will be addressing the topic, structuring the petroleum industry bill for long-term oil and gas industry competitiveness in Nigeria. Now, when you listen to the keynote address by Mr. Roger Brown, it is very, very clear that the real lesson is we need to ensure that the industry is positioned to be competitive, to attract the appropriate investment, which will invariably enable the advancement of our industry. So, Mr. Pedro, can you hear me, sir?
Yes, I can hear you.
Okay, Mr. Pedro, we're running a little behind time, but I think we can still adequately accommodate you. Welcome to the program, and it's good to have you, sir.
Thank you so very much, Amadou. Thanks for inviting me, and I thank the executives and the planning committee for inviting me for this event. I listened to the president earlier on and Mr. Roger. I think they've kind of set the scene for this discussion. I've got 15 minutes and I'll try to run through it as quickly as possible. So if you just go to the slide. So my name is Pedro Omotueme, partner with PwC, and I've been there for, wow, about 26 years now and counting. The agenda today, we're going to look at 3 broad areas. That is your third slide, global overview of oil and gas industry competitiveness, what's going on across the world. We'll review the current version of the PIB, and then we'll look at what I call the key differentiators for oil and gas investment destinations. So just 3 agenda, we'll look at them quickly. The global overview, review of the current version of the oil and gas bill, and then what is attracting the rest of the world. I think I'll try to make it as less complicated as possible. I'm not an engineer. Some of you are not accountants, so I can't speak your language. You may not understand my language, but try and present it in a very layman language that everybody can understand. So if we look at the next slide, let's look at the global economy. Next slide, please. So if you look at what's happening now across the world, next slide, please, sir. The global oil and gas industry is facing an investment challenge because the global oil and gas firms have been underperforming. The share price has been underperforming. The share price is a measure of the performance of the market. That's what the buyers and sellers are looking at. I'm sure you've heard in the news that Zoom is now bigger than ExxonMobil in terms of the share valuation. It's just overtaking ExxonMobil. And ExxonMobil is one of the biggest. Okay. So if you look at this graph, it just showed what has happened since January and how the share price of the BP, Shell, Exxon, Chevron is just plummeting, and the Fortune against Fortune 100 or even the Morgan Stanley's capital index, how the rest of the non-oil share price actually have been increasing. There's a quote here by a standard analyst that said the majors are struggling to convince any investor at the moment. There's a monumental give up on the valuation of these companies. It's just astonishing, and that's just continuing. You look at the next slide. The next slide compares Saudi Aramco with Apple, and the Saudi Aramco is a very big one, and see how over the period of time Apple has just overtaken Saudi Aramco, and I've told you about the story of Zoom and ExxonMobil. So this is what we're seeing in the stock market, and that's a big indicator to the guys in our industry about the challenges we're facing. If you're going to be raising funds right now in the industry, there's a shift away from the oil and gas industry towards the tech because of the uncertainty that we're facing. We know about the COVID-19 and the drop in oil price. If you look at the next slide, we wanted to see a quick overview of investment attraction to Nigeria over the past 17 years, and what the delay in passing the PIB, what the impact has been in the country. So what we have done is to do a graph between 2003 and 2000 and present, and we got this information from Resta Energy and our own analysis. So if you look at the cumulative annual growth rate from 2003 up to 2009, there was an annual growth rate of about 21.9%. Okay, in terms of additional investment into this sector, and then it kind of dropped between 2010 and 2012 by 8.9%, or we say 9%, and then increased slightly. And every time it increased, it was because there was an expectation that the PIB will be passed, and that's what you see the bottom chart here, the fourth chart, the color we have. So when there's an expectation that the PIB will not be passed, people are more assured of certainty of their investment. And since 2014 to today, the investment in the industry has dropped by about 18% year on year. Okay, so this just shows you there's an increase, there's a decline, an increase again, and then a decline. Now, at the moment, where we are now is comparable to where we were in 2003. So 2010 is not compared to 2003 in terms of the investment in the industry, and this we can tie mainly to the delay in passing the PIB. So if you look at the next slide, what we try to show in the next slide is there are a lot of capital projects that have been delayed, deferred, or whatever words you want to use for it. And these are major projects. Now there are different estimations. Some are saying 30 billion. We are conservative here by saying about 30 billion delay in project. One other analysis is about 57 billion delay in project because of the uncertainty in regulatory environment. And these are big projects that you are aware of. Either the Bonga Southwest, the Ibor, the Ohaji South. All of these projects have been delayed. Some of them, the FID has not been taken, or some of them they just delayed decision. Cash will go to the best place where there is certainty, and it's important that as a country we urgently pass the PIB and do something so that we can, the owners of the money can take urgent decisions and they agree to this project. Some of these projects, we're supposed to have started by now, and some are supposed to come on stream in 2025. If you don't start now, then 2025 obviously will not happen. Okay, and it's going to hurt us, hurt our economy, and hurt our employment, and hurt virtually everything we have as a country that depends mainly on oil. The next slide shows the what I call the break-even point and the payback period. I think Roger kind of hinted at that at his presentation. So if you compare Nigeria to North America, North America average break-even point. I think Mr. President also hinted at that at his earlier presentation, and the average the payback period. Okay, so Nigeria is very, very on the high. If you look at your extreme right side of your table, you see where Nigeria is, followed closely by Angola in terms of how much it costs to break even and the time it takes to break even. Okay, now there are various reasons for this, but as a country that's trying to attract investment, this is one thing we need to look at very, very seriously. How long will the investors get their money back, and how much will it take for them to break even? Okay, so now let's look at, after giving that kind of quick background of the industry, let's now look at the current PIB. That's next slide, sir. The current PIB. Let's have a quick review of the current PIB. So next slide, we see how long we have been on this. Now, we're talking about a 20-year period. 20-year period. I read in the papers recently that the Minister of State, His Excellency, says that by PIB, the current PIB will be passed in March 2021. Now, the jury is out on that, whether that will happen or not. Okay, I got my thoughts about whether that will happen or not, but I'm sure you also have yours. But over this period of 20 years, we have had various types and shades of PIB without even knowing exactly what version. At the time, we lost count of which version exactly we are talking about. So initially, President Obasanjo just started a committee, and then we came up to breaking up the PIB into 4 acts because we thought having just one act was going to be difficult. We broke it up, and then the Governor's Bill was passed by the Assembly and then to sign, and then now we now have an executive bill that have been sent to the Assembly. All the 4 have now been put back into one, and at the moment I understand the Assembly says, okay, let's focus on the finance bill first, or let's focus on the budget, finish passing the budget before we go in March or at the beginning of the new year, look at the PIB. So it's been a long journey. Now, if a child that was born 20 years ago will be in the university by now, middle class family will be in the university or even has even graduated doing his youth service. So it's a very long window, and that period, that delay has cost us a lot of money as a country. So next slide, we see the 4 sections of the PIB that have now been remerged into one. We had the Petroleum Industry Governance Bill, the Petroleum Industry Administration Bill, the Petroleum Industry Fiscal Bill, and the Petroleum Host and Imported Communities Development Bill. Initially, they were separated. Now they're brought back as just one bill. Now, like I said, the jury is out on that, how this will happen. But if indications and what we're hearing is anything to go by, I can see some governors, particularly good governors who are aggrieved about the Zamfara gold. A lot of us know about the Zamfara gold story about gold extracted in Zamfara being sold, and the governors are saying, if gold can be sold in Zamfara, why is oil in the Niger Delta not sold by the states, and why is it a federation affair, not, so all of that, I think a lot of challenges we're going to be faced with the bill come next year, and I think the storms are beginning to gather. If you look at it in the next slide, we just go through the components of the current PIB. There are 7 schedules that give details about various things, and then there are 5 chapters: the governance and institution, chapter 1; administration, chapter 2; host community development, chapter 3; petroleum industry fiscal framework, chapter 4; and miscellaneous provisions, chapter 5. I think for the purpose of this discussion, our focus will be on chapter 4, where we are looking at the fiscal framework, because that is the biggest item in terms of attracting investors into the space. So the next slide, you just look at the key components of the PIB. So in the governance and institution chapter, there's going to be an incorporation of the NFPC Limited, a limited liability company that will be established within 6 months of the enactment of the bill. That company will take over whatever the current NFPC is doing. There will be the creation of the Upstream Regulatory Commission, or the commission that will now handle the upstream sector. There will be a creation of the Nigerian Midstream and Downstream Petroleum Regulatory Authority, or the authority that will take care of the midstream and downstream sector. And then, of course, the some acts will now be repealed. The NIPC Act will be repealed. The PPPRA Act will be repealed. The PEF Act will be repealed. The PPTA will be repealed. The Deep Offshore Act will be repealed, and other acts that are related to the industry will all be repealed because we now have the omnibus and huge PIB Act. Of course, there's the host community development, which my cousins in the Niger Delta have always agitated for, have a host community that will ensure that the host community is taken care of both socially and economically. There will be an incorporation of the host community development trust. In the trust, what the current act says or current bill says is that 2.5% of the exploration and production companies' actual OPEX will be voted into this trust, and then that trust will now be allocated 75% to capital fund, 20% to reserve fund, and 5% for administrative. And the act actually describes how that will be used. The third thing we see with PIB is the reduction in the statutory tax rate. There will be no more PPT or petroleum profit tax as we know it. But what will happen in the interim, or what will happen in its place, there will be the emergence of the hydrocarbon tax or the Nigerian hydrocarbon tax at a rate lower than the PPT. We're going to come to that a little bit more. And then the petroleum operations the petroleum companies will now be liable to the CIT, companies income tax. There will be increased focus on royalties. So there will be no more zero royalty for areas beyond 1,000 meters depth. Royalty rates also will be based on production, terrain, and price. That's the way it is worked out. And then, of course, there will be extends royalty price by price. So as the price goes, royalty also will just follow. As you may be aware, we did have a current rule that has a price that was set, and I think that caused a lot of conflict between the IOCs and oil companies and the government, because when the price was supposed to be increased, the government just simply forgot to do it. And at the time, I'm sure you also read the press where somebody wanted to claw back all the unpaid taxes or royalties. But I think wisdom has prevailed, and that has been that will be dealt with by this new bill. There is now the production allowance. Prior to this time, there was the investment tax credit that will be repealed. Investment tax allowance will be repealed. Petroleum investment allowance (PIA) will be repealed. In its place, you will have the production allowance, and the production allowance will give it will be the lower of a $2.50 per barrel and 20% of fiscal oil price for grandfather contract. Grandfather contracts are contracts that are already existing, and therefore they will just be grandfathered. But for new production, new acreage, it will be the production allowance will be $8 per barrel and 20% of the fiscal oil price, the lower of that. So those are the new changes we see in the PIB, and these are significant changes in the PIB. The next slide, just quickly to apologize that it's a bit more technical, but I'll try and make it as less technical as possible. In terms of what we're comparing here is the current Petroleum Profit Tax Act and the PIB. And on the upper side of the slide, you will have the PPTA, the current one, and we compared it with the 2012 PIB and 2018 Petroleum Finance Bill. But at the lower section, you compare with the 2020 PIB. Okay, so I think the summary of this is that the tax rate will drop. So if you look at the PPTA, for example, for the onshore and shallow waters, either at 85 or 65.75%, and compared to the bottom part where you have the PIB, it will now drop to 30% CIT plus 42.5% national hydrocarbon tax. Okay, so if you compare 82.5 to or 72.5 to 85, there's a drop. But like you know, the devil is in the details. So the tax consultants will look at this and see which one is better. But I think on the overall, is agreed that the rates are much lower than before. The rates are much lower than before. Okay, so the rates are much lower than before. So if I go to the next slide, and the next slide, we just came up with a list of items we think we should be considering in order to enhance the current bill. I think there's still room for engagement with the presidency, with the executive, and with the National Assembly in order to enhance what we currently have. So that's the first question. Can this PIB be improved? I think the answer is a big yes. If the industry acts together, I listened to Roger talking about working together as a group, as an industry, and I think the industry needs to work together to engage with government. So the host community fund, we mentioned that earlier on, 2.5% of OPEX. We think that's a duplication of your NDDC levy of 3%. So if you have a whole community fund of 2.5 and you have an NDDC levy of 3%, then you're going to have a 5.5 additional levy on the operators. So what we're thinking that this may lead to the repeal of the NDC Act, and that should be considered. Otherwise, I think there's something we need to deal with. There's the production allowance, and the proposed 2.5 per barrel may not be sufficient to fully recognize the impact of the multiple costs that you have. We've said earlier on that in Nigeria that the cost of doing business is much higher than elsewhere in the global oil and gas space. So if you now limit your capital allowance, don't forget I told you you're going to remove all of the investment allowance and all of that, and you just come up with a production allowance, then we think the 2.5 may not be sufficient. I think that's what the oil and gas industry needs to start engaging with government. There is a mainstream gas infrastructure fund. The introduction of additional levy on operators may stunt the growth of the mainstream and discourage investment in gas. Okay, so we have another gas infrastructure fund. The environmental remediation fund, financial contribution for remediation of future environmental damages appear to be a duplication of the abandonment fund, because most your current international financial reporting standards, IFRS, already asks you to do an abandonment. So having a remediation fund and an abandonment fund in your books would be a duplication. We don't think at the moment that the PIB considers the various other costs that you're currently bearing. There are ministries that come to review, state governments are coming, local governments, authorities are coming. I think there's just additional, there are multiplicity of rules and taxes that you're dealing with at the moment. There's an interesting portion about the domestic gas obligation, where the domestic gas is being prioritized over export gas. I think that will significantly disincentivize people who are focused on export. But we do understand the need for that is you want power in the country, therefore you want gas to power, but that also needs to be reviewed. I think on the overall, the enactment of the petroleum industry bill is a good thing. Is long awaited bill. It's caused a lot of delays, but we think that some areas that we need to tweak it to make it much better than it currently is. And I think that's a big ask of you guys in the industry, something you need to work with your colleagues to ensure that the bill is much better than it currently is. Well, the next slide, we are comparing the Nigeria's fiscal terms with some selected African countries, just to see how we're faring with the competition across the Gulf of Guinea, how we're faring with competition. So if you look at this slide, the first two buckets is just the current PIB, the current rules, or the current tax rate versus the PIB, comparing them, okay? And then the bottom part of the slides, now comparing what we have, both current and proposed, against what the rest of Africa, Angola, Cameroon, Congo, all the way down to Sao Tome and Principe. So if you look at that, I think your conclusion you reach that yes, the tax rate in Nigeria is really high. At the point, our royalty rate also was higher than the rest. I think the major driver of the PIB, as we see it, is that the government wants to increase government take. So if you look at the total government take compared, if you look at all of the funds that are set up, royalty, taxes, if you look at the total government take versus what we currently have, I think the total government take under the proposed bill may be higher than what currently exists. Okay, and that's something that we need to engage with government just to ensure that in the process of bringing a new rule, we don't now discourage and disincentivize the players in the industry. I think my 15 minutes is almost gone, but quickly, assessment of key differentiators of the oil and gas investment destinations. That's the next slide. And something that I'm sure just food for thoughts for the rest of the day, and some of them have been mentioned by Roger already. There's need for clear regulatory framework. The need for that cannot be overemphasized. Okay, portfolios have been realigned all across the world. People and companies are playing to their strength. People are cultivating the right talents. The right talent as a country, having the right talent is very, very important if you're going to be a differentiate yourself from the rest. The licensing framework, licensing arrangement and the framework needs to be harmonized and needs to be clear. There needs to be efficient and oil and gas value chain. And then, of course, digital innovation is quite important. So we see this as the 6 drivers of differentiators all across the world. If you're going to attract investment in Nigeria, these are things we need to be doing and doing pretty fast. So I think that kind of brings my presentation to an end. I hope I've not bored you too much. And thank you so much once again for inviting me. Thank you, sir.
Mr. Pedro, how can you bore us? You literally, in a relay, a well put together relay team, it's all about the transition, how you take from the first baton to the next person. And this was completely seamless. Thank you very much for bringing to bear all the levers, specifically in the PIB. You were trying to be in the middle. You were not very optimistic. You're not very pessimistic. You're just trying to put the facts as they are. And your analogy about taking 20 years to put a bill together and the impacts on value erosion so far on our industry was very, very clear.
Thank you, sir.
If there's one major takeaway you want our participants to leave with, what would that be?
I think we need to work together as an industry to ensure that this bill is finally passed. We need to, I don't think the industry is bullish enough in influencing the regulations in Nigeria. The regulations that affect the oil and gas industry, I don't think so.
So in short, you're pushing for more, not just advocacy, but advocacy that actually affects and push and changes or influences policy to enable the industry.
Absolutely. Absolutely.
Okay. All right. Thank you very, very much.
You're welcome, sir.
It's been a pleasure having you. I'm sure this will spur on more and other conversations as we proceed forward. All right.
Thank you so much.
All right, sir. Next on our bill is, it's interesting. The oil and gas value chain, as we speak, starts from exploration, and the next speaker invariably will focus on those opportunities at the very front end of our value chain in exploration. In fact, much further than that, because this is frontier exploration. Okay, excellent. All right. So, as I was saying, the next speaker will be taking us through conversations on how do we actually optimize that front end part of the value chain in exploration. The topic today will be inland basin exploration, opportunities for cost management. Who else than Abdullahi Bomai, the Group General Manager, Frontier Exploration Services, NNPC. This is a friend of Nape, and the activities and successes of this department have been in public domain, in the national domain. The last 18 months, they have been doing big things across the country. Abdullahi Bomai is well known for aggressive development of inland basin, and like I've just said, the Kolomari River 2 successful well is out there in public domain. Without much ado, let me invite the GGM FES, Mr. Abdullahi Bomai. Over to you, sir.
Thank you very much, my brother. I wish to thank the ESCO of Nape for giving me this opportunity to present this paper to this audience. The title of my paper is Inland Basin Exploration Opportunities for Cost Management within the general theme of levers for optimal cost reduction in Nigeria's oil and gas production, positioning for the new normal. Please, next slide, please. This is the outline of my presentation. If we look at our own portfolio of operation in the frontier exploration services of the NNPC, virtually it covers the upstream value chain. We will look at the current reality in exploration cost management. Then we look at what we have done and what we are doing to enhance prospect maturation and drilling strategy. Then we conclude. Next, please. Yeah, this is to show our profound gratitude to NMPC, our consultants, organizers of Nape, and all those people who have contributed to our successes in the frontier exploration services. Next slide, please. Yeah, if you look at our own area of operation, as I said, is really in the upstream sector, but there are different cost components, including capital cost, financing cost, production cost, admin, and the rest. But we would like to concentrate basically in our portfolio, which is on capital cost. Basically in the upstream, what do we try to achieve is to find oil and gas pools. First is we try to look at the area, which regions and basins actually have the potentials. Then within the regions and the basins, which blocks, then where on the block. Then the next is the development aspect. How to get it out, where in detail are the reserves. What to build, what are the kind of facilities? Will it be profitable? These are all questions that the upstream actually try to solve. Then from the ground to the refinery is another aspect also. How to manage the field, how to deliver the crude. Next, please. So as geoscientists, we need to answer questions such as, which areas offer the most promise? Then what should we expect from a particular well? What type of hydrocarbon, oil, gas, or condensate? What amount of hydrocarbon will we recover? What are the barrels that are out there? What sort of flow rates can we expect? How risky is this well? Basically, this is where we operate in the oil and gas industry. And the cost management involve both ourselves and those who are going to come and operate these blocks after we might have finished our mandate, after we might have delivered our mandate and have moved out. Next slide, please. Then the current reality, what is the reality right now? Is that the normal might never remain the same, given the dynamics of factors at play within and outside our industry at large, and the peculiarities we experience within the socio-economic space of our country. Hence, Nape deemed it necessary as industry leader to take the bull by its horn and look at the new normal, so to say. Then again, the COVID-19 is a well-known thing that actually affected the industry negatively. We must come to terms with all kinds of things that either increase our cost or actually reduces the cost of what we produce. Next slide, please. This is our exploration workflow. One is we try to identify opportunities, deploying all kinds of technologies that I mentioned earlier to identify regions and basins and blocks and wherever that hold good promise for commercial discovery of hydrocarbon. Once we do that, we assess the prime areas, acquire seismic data, interpret, process, assess, drill Y-cuts, then there are two options, either success or failure, confirmation or what. So I would like to say a lot of these technologies, and we have identified opportunities. We have developed very robust model, exploration model that has led to success in the frontier basin. We have discovered commercial deposit of hydrocarbon in the upper Benue Trough. As I said, we have developed a very robust petroleum model. We know where the kitchens are. We know actually we have a good idea of the maturation and the expulsion and migration and the trapping. So we have started testing all these things. And the two that we have tested has led to success, which we have the library of information. Next slide, please. So then if we look at our own portfolio, where are the costs coming from? They are coming from exploration, development, production. In the cost management reduction, however, more emphasis are usually placed on production costs, as it is the aspect of operating costs readily related to the market price of petroleum. We are aware that the market price is low right now. The challenge being that the effect of resource depletion will eventually outweigh the effects of technological advancement and other cost-saving measures as the law of production decline sets in over time. Whether at a single field, as at a single field or basin scale, we have a lot of challenges. So what are the cost management measures that I embarked upon? And what is it that when we finish and might have left, other players will come and leverage on? Next slide, please. So that calls for a more holistic approach to cost management, taking exploration and development costs, which together contributes about 2/3 of total operating costs. Continually, we need to add reserves through deliberate exploration programs. And the easy to reach hydrocarbon in the Niger Delta are gone. But we will like to inform our listeners that this easy to reach hydrocarbon, they are actually available in the frontier basins. So what cost management measure that we have deployed is really, looking at the high impact technology, then the use of analogs as well. All the frontier basin, 7 of them in Nigeria, we have looked at them and we have identified the analogs in different parts of the world. So this basically has led to us reducing our risk as well as cost, because whichever basin we look at, we have the analog. For example, if we look at the Benue Trough, the analog is the Doba Desio and Salamat Basin in Central African Rift System. So then the Sokoto Basin is really, the analog is the Lake Albert of the East African Rift System. This, when the exploration strategies in these different analog basins are deployed in the Nigerian inland basin, it actually helps to reduce cost. Next slide, please. Next slide again, please. Next slide. We have, as I said, we are operating within the capital cost reduction or cost management area. Low-cost unconventional technologies have been deployed in all our inland basins. And we have deployed full tensor gradiometry survey in the Sokoto and Bidda basin, and also in part of the Chad basin. We have also deployed stress field detection technology in some of these basins, which actually looks at the stress field in the stress field and also tell us of the presence or otherwise of movable fluids. This cost-effective exploration strategy saved NMPC Corporation millions of dollars when compared to the conventional 2D and 3D seismic acquisition over large areas of the frontier basin as practiced in the 80s. Next slide, please. These are some of the aspects that we were able to take out or also minimally apply to high grade our basins for possible occurrence of commercial hydrocarbon. Next, please. So in looking at the unconventional technologies, these are some of the considerations. One is that they give us opportunity for large coverage. We can cover, like the Chad Basin is about 123,000 square kilometers. So we were able to cover this area with relatively cheap technology and high-graded part of it. Then the cost of deployment also is really quite minimal. Then all this we were able to achieve within short time. And the success rates, especially in other parts of the world, has been quite considerate. For example, the FTG is the main exploration tool in Kenya and Uganda. It has actually helped these countries to discover hydrocarbon within short time. Then the permits, many of them, the permits are quite easy to get. And many of them, they are either non-invasive or minimally invasive. And a lot of them have direct hydrocarbon indication. Then some of them, even they come with funding options, which some of the technology providers are ready to provide funds for deployment and use of the technology. Then pilot projects, many of them were client funded. So with this, it gives opportunity for cost reduction and cost management in the frontier basin. Next slide, please. So for those people who are planning to come in and invest in the frontier basin, especially looking at our successes, these are some of the data sets that we have on ground. We have a lot of 2D and 3D seismic data sets. We have gravity magnetic, both the raw data that we have acquired and bought from providers. We also have conducted surface geochemistry over a large area, and we have seen presence of a lot of C1 to C5. Then we have stress field detection data. We have wetland and wellbore data sets. These data sets, definitely, are we all aware, they are actually the data that belong to DPR. So they will very soon be available on the National Data Repository, which is being operated by DPR. So a lot of this information can be accessed there. And this, all we know that it will considerably help would be investors to reduce their costs minimally. Next slide, please. This is just an indication of our own processes, the ones that we have deployed. We actually first look at the basins, as I said, we integrate information, then evaluate the charge, deploying surface geochemistry techniques. Then we acquire 2D data and the infills, then 3D. At the end of the day, we drill exploratory well and appraise that, and we de-risk them using some other unconventionals as well. These are activities that will actually offer opportunities for cost management for those people who are coming after us. Next slide, please. So discoveries have been made globally in various basin types with diverse tectonic regimes, structural settings, trapping mechanism, and depositional environments. This implies that there are a series of analogs present today for the Nigerian inland basins. Challenges associated with sparsity of data in the inland basin, which have been largely underexploited, can be significantly resolved if the analog process is done right and a well-tailored exploration program is designed, which has opportunity for cost reduction. A study of the behavioral trend of the industry shows that it is more economical to exploit the easy reach results before taking on the more complex ones, which are predominantly available in the inland basin. Then while the more matured Niger Delta basin may no longer have easy to reach targets in abundance, the frontier inland basin, as I said, may just be saturated with this kind of targets. So it's really an opportunity for us to invest in this place at a minimal cost. Next slide, please. These are, I mentioned some of our achievements with the discovery of commercial hydrocarbon in Benue Trough. Then combination of advancement in technology and analogs provide present-day industry the capacity to detect economical hydrocarbon accumulations in places that were previously considered none. Prospective, these discoveries will not only add to the nation reserve, the implication will be that more easy to reach targets can be developed at cost margins that allow for profit. Next slide, please. In conclusion, beyond the efforts required in successful field exploration and development, exploitation of resources requires infrastructure and market for sale of extracted petroleum. The inland basin in Nigeria are largely frontier areas for this kind of transaction. However, there is a ready market in the Nigerian energy space and neighboring countries for off-taking of the extracted industry. And the 200 million people population of Nigeria, they really offers opportunity for these products to go into the market. So this challenge can be confronted through collaborative efforts with other players within the government and private sector in areas cutting across upstream, midstream, and downstream sectors of the industry. The collaborative arrangement will guarantee that risks and rewards are shared equitably among parties. The time to reverse this trend of reserve depletion is now. The inland basin provides the opportunity for us to discover and develop easy to reach, low cost, high quality petroleum within margins that allow for profit. This can be achieved through the use of advances in technology, analogs, and collaborative efforts. Thank you. This is the end of my presentation.
Thank you very much, sir. Thank you, Mr. Bomai. Thank you for providing those insights. It's clear that even in exploration, we have to ensure that we are efficient and we continue to explore opportunities to make that whatever drilling campaign or exploration campaign as cost effective as possible. From your perspective, with the success you've had in the Benue Trough, what's the plan and strategy for frontier exploration going forward in your campaign to open up inland basins? What's your plan?
Okay, as I mentioned in my lecture, we have looked at all the inland basins and we have evaluated them using all the tools, all the data that are on ground. We have evaluated them and we have a working knowledge of what could be found in each of the basins. And we are now gradually moving from one point to another, maturing them. So you might have heard of our operations in the Middle Benue Trough. We are currently acquiring seismic data, 3D data in the Middle Benue Trough to validate what we have seen in the technologies we have deployed. We have also deployed FTG. We have acquired FTG data on Bidda Basin and Sokoto Basin, and as well as some parts of Chad Basin. We have seen a lot of opportunities there, but as you are aware, our mandate stops at discovering these hydrocarbons. Once we discover hydrocarbons, we actually hand over all the data and everything to DPR for licensing. But just in summary, we have done a lot, and we will continue to deliver on our mandate. As soon as we make finds, definitely that information will be passed to DPR, and the whole public will be informed and they will be aware of it.
Okay, Boma, your video is off. If you don't mind switching on your video.
Yeah, okay.
All right.
Okay, thank you. Yeah.
All right, it's on now, but we still can't see you. We just wanted to thank you for your time and recognize your contribution to the conference workshop. Thank you very much, sir.
Thank you very much. I appreciate.
All right. So
my regards to all the ESCO of Nape,
right,
colleagues, and all the listeners. Thank you.
Thank you so much, sir. So we are still staying within the NNPC family. What we're doing now is we're moving directly to to the National Petroleum Investment Management Services arm of the NNPC, and we will be inviting the group general manager for Nape, Mr. Balawunti. Mr. Balawunti has a lot of experience within the NNPC group, where he has acted in multiple capacities, technical and commercial, to management of the NNPC group. He will be sharing with us how feasible it is to pursue this $10 dream or this $10 target that we have set for ourselves. If there's anybody in the industry everybody wants to hear from, it is Mr. Balawunti, because he represents the NNPC on most of these contracts, whether it's joint venture contracts. So I see there's some feedback. Let's make sure there's some feedback. All right, so let's make sure is all right, so is how do we address that? Okay.
Hello, Abdulatif, are you looking to me?
Yeah, we can hear you, but we had some feedback earlier. We're trying to make sure that that's. We can hear you, but we had some feedback earlier. We're trying to make sure that that's. All right, I think what we'll do is just let you do your.
Okay, I actually lost you the last seconds you spoke.
I think what we'll do is just let you do your presentation. Your presentation.
Okay. Do I say good morning, Nafe, good morning, colleagues. Let me thank the organizers of this event. Obviously, this is a very important organs of our business. Like Bomai said, everything starts with the way and manner you find the oil, and then all the way to the infrastructure that you need to monetize the oil and gas that you discovered. So from this end, I think sometimes I ask Alex, why did he choose me to speak at this particular moment? Considering the fact that I'm just going to be crashing into the G&G community, but he did mention that he has no option but to invite me because of the current circumstances that the industry has found itself, which is basically to say that we are operating in a very high cost environment. And because the cost environment is very harsh and it underpins our survival in the industry, we have to do what we need to do to bring it down. Otherwise, it will bring us down. So the option is either we bring costs down or costs bring us down. And I think that was the topic that they asked me to speak. The question, if I remember, is basically that whether or not a sub-$10 UOC is achievable. I told him that I will reverse the question. The question is whether or not over $10 UOC is sustainable. Can it sustain the industry or not? And if it's not sustainable, what can the industry do to bring down this cost before the costs bring us down? So I'm ready to go into my slides. So if the organizers will put it, that would be great. And if they want me to speak, okay, thank you very much. Now, this is the topic I've been told to speak. Is it achievable to have an operating cost of sub-$10? In other words, to have under $10 cost. And I say that it's not a luxury, it's a must do for the industry if the industry needs to survive. Can we go to the next slide? So what I did was basically to give some outline, basically to look at the global trend. And I think a lot of it has been spoken upon by Robert and by Pedro, and then subsequently the Goma has amplified some of the issues shaping the industry. The other element is what are we going to do to contain this cost? We have to do what we need to do, and we're going to share some ideas on what we are doing in Nape and the entire upstream community. And we'll also look at trend and drivers, and then we'll see what are the key takeaway that we're going to have in our conclusion. Can we go to the next slide? Now, maybe you can put it on slide, but if you can't, then that's fine. First, some quick facts. Let me start with the offer quadrant, the one in the white. Just a reminder that we closed our year 2019 with our total reserve size in this country of a little bit below 37 billion barrels, precisely 36.89. And we also closed the year 2019 with an average production of about 2.1 million barrels of liquid production containing both condensate and oil. And if we have a reserve size of about 37 billion barrels, and if we are to continue at the rate of 2.1 like we did in 2019, I think the arithmetic will show that in 40 years, we'll be out of oil if we don't do anything to increase the reserve size. So I think that is the key point that I want us to take this. In 40 years, and some of us are under 40 in this platform, which means if you are going to stay till 80 years, it means you will come across a Nigeria without oil. And so the question is 4 decades enough for us to plan and do what we need to do, either to increase the oil reserve or to do some other thing to invest on our investment in oil and gas so that we can create a more sustainable environment. But then we even have an aspiration. The aspiration is that by 2023, governments say we must increase our production to 3 million barrels. If we are to do 3 million barrels and we don't do anything on the reserve side of the equation, what it means is that in basically less than 4 decades, precisely about 3 decades, we'll go out of oil. Again, some of us will see a situation where there's no oil. But I do know that the industry will respond. But how quickly they respond is key, most especially looking at the trend that we need to produce whatever we have so we can invest in other segments of the economy. If you look at the gas, it's following the same trend. We closed there at 203 TCF of gas. And if we are to continue producing it at about 8 BCF that we're doing today, it will take us 65 years to benefit to continue to produce that gas. But what is key about the gas different from the oil is that we are, in a way, clearing significant component of what you are producing, almost 10% of that, about 800 million scope. And for some of you who are known to convert gas to power, you know that with 800 million scope, we will be able to simply generate up to 5 gigawatt of electricity. So what it means is that by choice of the industry, we are clearing 5 gigawatt of electricity. And don't forget that our production today of power is far less than that. Our generating capacity, we're doing less than that. Install may be more than that, but the reality, we're doing something that generates between 4 and 4.5 gigawatt of electricity. Now, most importantly, it's not everything that we produce that we clear and then monetize. There's significant component which constitute almost 2.5 BCF that we are re-injecting in the name of operation. But we do know that not all the re-injected volumes are meant to enhance production. So if you take 2.5 BCF and you convert it to power, that will also give you about 15 gigawatt of electricity. So between re-injection and flaring, we are wasting, let me use the word, also optimally utilizing the gas in a very undesirable manner of up to 20 gigawatt of electricity. That is the jeopardy that we put this industry. That's where we found ourselves. And so if you look at the target of producing up to 48 gigawatt of electricity, then you can see that 8 BCF can translate to that, and that will power the entire economy that we are looking to develop in Nigeria for the next 20, 30 years. Most importantly, today our average production, I did mention, is generating between 4.5, but let's say for the purpose of this, we consider 5 gigawatt of electricity as what we are generating. Now, that's other part, and I think, again, I will be crashing into the G&G community. I've been asked several questions that how can we explore at a very low oil price? And I say, look, we have to look at the geology of Nigeria. And the reality of it is that we find oil almost everywhere we are producing oil in the Delta today. Only about 3% we are producing at below 15,000 depth 15,000 depth. So what that means is that all the oil we are producing is actually very much on the surface. So what can we do? Can we go deeper? I believe, I'm not a geologist, I believe we can do a brownfield exploration that will go deeper. And I think one of the things Nape should focus on is what can we do to go into that? As considering the fact that we have infrastructures already in place in the Niger Delta. So if we can find oil in the same location, that would mean we may have a little spend that we need to do to basically put infrastructure for monetization. Again, it's important to note that most of these finds were achieved through 2D seismic. So there are no 3D. Today we're talking about 5D. So even if you go 3D, there are technology and other things that could be done, which Robert, I think, has worked a lot of it, with some element of enhanced oil recovery. You should be able to have significant increase of production that you can come at a much lower both exploration and production costs. And most importantly, if you go basically into the vast untapped resource of 3D and above, that will also further enhance the technology. I just put this as a stage to look at the fact and the reality, and then what will the path dictate for us to do. And looking at the reality, can you go to the next slide? Is to see that we do know that our industry has to follow cost. We don't have, have to follow price. We don't have, can I have next slide, please? The industry basically has no option but to be a price taker. The oil and gas industry must accept whatever price the market presents. And we have seen this over time. For some of us who have been in this industry, we've seen $8 oils, and we have seen $148, $150 oils. And we have seen a reversal, what happened this year. I think Rogers has spoken so much about it. Basically, we opened there at about $70 oil. Obviously, there were a lot of issues regarding oversupply, and then there was debate between whether or not to cut costs between Russia and Saudi, and then the pandemic came in, and we saw a lowest price of almost $10. In fact, futures go below zero. And so this is what we saw. We saw some level of recovery, but the key point is that irrespective of where the price is, as a producer of oil, as practitioner in the upstream, you must follow the price. If the price is $20, you must structure yourself to be able to participate in that market. Otherwise, you shut yourself up. And if it is $40, you also structure yourself. So the resilience and the tenacity of the industry is very much dependent on our ability to manage costs in such a way that the cost must be below our price, since we don't have control on price. What we have control, obviously, is our cost and the level of our production numbers that we're going to generate. And I think that is key also in setting the state of what we are going to be talking. Can we go to the next slide, please? Now, I think I will just browse about this. I think Robert has did a good justice. Basically, is to show what the investment platform is. We noticed that the highest level of investment recorded in this industry was in the year of our Lord 2014. And what led to that? At that level, I think there were very high price, and there was promising that that price is going to remain where it was going to remain. However, that led to a lot of investment, which ultimately it led to an oversupply, which we started seeing the oversupply that brought the price down around 2015, 2016 to about $28 or thereabout. And then we see a stability. And that stability was truncated by the dynamic of the pandemic and several other things. Of course, the pandemic has been spoken upon. The consequence of all this today, we have seen a much deeper investment cut from even the one that we saw from 2014 to 2015. What we saw is almost 26%. I've seen some numbers saying 30% of CapEx has been taken off the market. But most importantly, most of the industries, including the mighty ones, the big ones, are now facing what we call liquidity crisis. They are accelerating plan for diversification and portfolio rationalization, and we've seen a lot of staff layoff across the globe. Our production shut-in is something that we all see is very rampant across the globe, and of course, I did talk about portfolio balancing or rationalization. And so some of them has postponed dividend till further notice. Some are borrowing to pay dividends. And what matters is that the dividend yield is terribly, terribly low. And of course, when there's no dividend, what that means is that investment dollar will continue to drive. People will deploy their money where they're generating more. Most likely technology will and other things that are outperforming the oil and gas industry. This is again our reality. Please can we go to the next slide? The next slide is look at least some of the factors. I did mention like it's Nigeria, but it's not Nigeria, it's global. But I wanted to put it in context because we're talking about Nigeria. These are every factor that are shaping the industry. They're exercising immense pressure. When you look at the fiscal issues sitting at the inner side of the concentric is actually the consequence, the outcome of all the pressure that the market is having. For us, we're in economic recession, and you put everybody in recession. And the reason why there's recession, you can see there's economic disruption, monetary pressure, fiscal pressure, all kinds of pressure are exercising so much on the economy of every nation. The consequence, obviously, is what we see getting every country into recession. And when you look at the wider outside world, you can see the global demand is deteriorating, oil price is coming down, and we've seen reduced access to capital. Not only there's reduced access to capital, there's increased impatience of any investment capital. Everybody wants to invest in not on a long haul, but something that can just generate the money in a year or 2 or 3 to get his money back. And this industry is a long haul industry. You have to be thinking about a decade and maybe possibly 2 decades to be able to invest. And so that capital is gone. There's no more patient capital in the world. All the capital are becoming impatient. We have seen trade disruption, and we've seen all kinds of pressure coming to impact on the industry. The consequence of that, it plunged all nations, I can say all nations, into recession. Now, can we get out of that? Yes, we can. But how will we do it? I think is something that is very much dependent on what we choose to do. Can we go to the next slide? What other people are doing, and it's always good to learn from the best. The best are represented by the IOCs, you can see, and I think these are press code. They are direct, they are publicly available, so I can read them. Everybody can read them. Royal Dutch Shell, they have launched Project Reshape, what they call Project Reshape. And by that, they're slashing 40% of their costs, 40% of their cost emphasis. That is Royal Dutch Shell, the mighty Shell. We've seen ExxonMobil suddenly becoming someone looking for palliative from trunks. They've taken palliatives, but beyond the taking of the palliative, we've seen a 15% reduction in their workforce, and several other measures are being taken, and the rest of them. Chevron is not left behind. 15% of their global workforce across Australia, across all their territory, including Nigeria, they're trying to rationalize and reorganize themselves for more efficiency. And we've seen other initiatives that is being taken. There are some that I group them, what I call capital funding. They're looking at asset divestment. They're looking at suspension and reduction of dividends. They're looking at all kinds of things that has to do with capital rationing. We've seen other groups that are focusing on their headcount. You can see them in different thematic areas. And some has just say, like Devon, like Marathon, there's Continental and Co. They're just looking at reducing their OPEX as a sum total. And if you look at the OPEX, it's all part of the working capital and the real capital for CAPEX as well as HR. So these are some of the initiatives that are being done across the globe. And this is not limited to only international oil companies. It's also affecting the national oil companies. So across the globe, everybody is trying to match his cost in such a way that he can continue to be profitable. Can we go to the next slide, please? Now, where are we? And I think I want to take this opportunity to make some certain clarification. Often, including Nape, did refer to the $10 we are talking as a cost of production. That is not what NAPIMs mean. In the NAPIMs world, cost of production is made up of two components. It is called the CAPEX and the OPEX. The CAPEX is obviously is capital expenditure, and the OPEX is operating expenditure. So what we are referring to as unit cost of operation is T1, and that's the one that we're targeting, that we say it must be less than $10. T2 obviously is dependent on several factors. So we'll leave the T2 for now, because the T2, if you choose not to invest, obviously there's a consequence. It will tend to increase the OPEX. Of course, if you are producing higher barrel and then you don't invest to maintain that or even to increase it, the infrastructure will continue to attract operating costs, and then it will balloon the operating costs. The combination of our T1, which is our operating cost, and the T2 capital cost, we call it unit technical cost of production. So when you are looking at what is the cost of the barrel, you must aggregate the T1 and the T2. And in many instances, we do know that they are going to range between 20-25 for us to be able to be tenacious, for us to be able to stand the test of any economic pressure. If we cannot do that, then there's a problem. Today, we know where we are, and that is what we have in the right side of the quadrant. If you look at our 2019 numbers, these are all the PSC company and all the JVs under NAPIMs aggregated together, and then I have the average in the middle. And you can see our UOC. It generated all over from somewhere in the neighborhood of $18 in 2014 to somewhere the lowest we have seen is 2017, where we are having it in between around 14. But we're making a significant effort to drag it down from the 2019 level. Are we succeeding? Yes, we are. We've seen some sign. And when you look at the third quadrant, which is the one lower at the right hand of the slide, you can see where we are today, from January. From January today, our JB cost has dragged down a bit, and our PSC has also dragged down a bit. What we have seen is an average Y to date from January to date of $13. Obviously, if you know where we're coming from 2019, we have shaped between $2 to $3 from where we are, from $16 to about $13. And I think we're trending downwards. We've seen some resistance and other things from the industry. Of course, it's not deliberate, but the circumstances we find ourselves. But we're collaborating with them to see where we can do. Some of the measures include what has been mentioned by the previous speakers. Can we go to the next slide? So this slide basically, I think, is give us our reality, and then let's also deep dive and understand what we are talking about. Can we go to the next slide? Now, this is the DNA of our operation, guys. This is the DNA of our operation, and if there's nothing that you would like to take away, please take away this slide. If you are in E&P business, this is your reality. Subject to one or two variation that may be very, very specific to you. Your level of efficiency can change this, but on a general note, what we have seen on the JV side, you have seen when you produce, even at the new PIB, you got to get 18%. But at the old PIB, when you are producing, most JV will pay 20% royalty. So if you consider the cost of oil, I mean, the price of oil is $40, which probably is going to be somewhere in the average of 2020. The first thing you have to do, first line chart, you have to remove 20%, which is $8 right at the bottom. So that you have to give. And then when you give the next thing in terms of the waterfall, you must pay your operating cost. Operating cost that we have seen, I've just shown you what was the average, is about $13. But in this particular circumstances, we use $12. And if you take it, and then you look at your CAPEX spend in what we have seen some of the statistics from Woodmark and other things in the neighborhood of $15 per barrel. Now, all this in our cost, if you take 15, add it to 12, add it to 18, that will leave you with basically about less than $5. At less than $5, you have to pay your PPT. When you pay your PPT, you are basically going to be returning to your shareholders something less than $1. That is the reality. If you are in the JV space and you are able to get between $1 to $2, you must be very efficient. And that's the kind of business. Whether that business is the best business that anybody can deploy his money is something that we need to talk about. We can only be relying on hope. What is the hope? If oil goes 60, what are we going to do? If oil goes 70, what we are going to do? But the industry is not that disciplined. As soon as the oil price starts going up, we become reckless with our cost, and then we forgot that we need to do things to survive. The reality is, if you are taking a view that the long-term oil price is going to be between 40 and 45, then this is your reality. Unless and until you are able to pull down this cost, to bring that $12 to less than 10, to bring that $15 to something much lower, and obviously so that you can have much more money to deliver to your shareholders, you cannot succeed. In the PSC space, it's not that different. The UOC is basically same. Of course, some of the deep water, they have a much slower UOC. They don't have royalty, but the CapEx is high, and that's why they are able to return up to $4. So if you are in the PSC, in the deep water, chances are you may be able to bring to return to your shareholders between $4 to $6 as profit. For us in the Nape space, if we aggregate this, we are struggling to see how much we can deliver to government. And that is the consequence. And if you look at the right, we just wanted to show where we stand in the committee of OPEC countries. If you look at the OPEC countries, we are all relying on oil for our budgeting. And the break-even budget numbers given by OPEC based on its membership are displayed exactly the way they presented it. What it means is that for any country to be able to fund its budget effectively, the number that you see is the numbers they want to see as oil price. For Nigeria, for example, unless and until we are able to get above $100 oil, it means we can never fund our budget. We have to keep borrowing, we have to keep doing all kinds of financial engineering to be able to survive. And I'm not sure whether we can have three-digit price of oil. I don't think we can ever have. So if you are looking at a break-even price of over $100, you know, it's not sustainable, it's not achievable. Those days were gone. They were gone with the winds. They can never come back. Now, of course, we can never say never, but what we can see, as far as we can see, is impossible. Even Saudi Arabia, they need a price of $64. Kazakhstan, $64. The lowest is Mexico, obviously. And if you understand that the production dynamic of Mexico, and that's why you can see them. Of course, Qatar is not about cost, it's about their population and their aspiration. And then you can see Russia. So obviously, for you to be able to survive, every country, OPEC and non-OPEC, that are in the Declaration of Cooperation, they need this number. The lowest being Mexico. And Nigeria, you can imagine where we are. So in other words, we cannot any longer fund our budget. Can we go to the next slide? I've taken this time to really show the reality that we're being confronted with. And if we are to save our industry and to make the industry survive, we have to do something. Otherwise, we'll be confronted with what is on the slide currently. Low oil price has come to stay. The best thing is to imagine that oil price is going to be in the 40-45 band. And then if your production costs continue to remain high, then you are in for trouble. As long as you are not going to address the issue of high oil price, then there's a serious problem that we're going to have. And some of the issues that we have seen are issues to do, and you can see in the further analytics. HR is a key issue. Logistics is a big one, and handling cost is huge. Rogers talked about reconciliation losses. Rogers talked about crude handling charges and all what have you. These are the three most important cost drivers as far as the industry is concerned. And we will deep dive into them and see their consequence. The accumulation of all these factors mean that for me, who I am the steward, by steward, I mean NNPC being the steward of the federation, being the trustee of the federation that is expected to fund the federation account, we will not be able to return our money to the account. And it means we will have failed in our responsibility. And therefore, to address the issue of cost so that there will be money is absolutely what NNPC is meant to do. And therefore, we're collaborating with the shareholders together to see what best we can to rescue this industry. Emphasis, $10 is not a luxury, $10 is a must achieve. So $10 must be achieved if we are to salvage this industry, to put it on a survival platform. Can we go to the next slide so we can deep dive into the reality? These are the major cost drivers. But like I said, we're going to focus on three of them. So I don't want to waste my time because the other slide will also speak to this. Can we go to the next slide? And if you go to the next slide, you see that 70% of our costs, I'm talking about UOC costs, are anchored about 3 thematic areas. 38% is HR and HR services. 19% is logistics. And direct handling, like I say, is 13%. Put them together, 70% of our cost driver are around this. By Pareto principle, if I can address this, I will have been successful in addressing much of the issue that has to do with cost. That doesn't mean we're not going to address so many things. We have to address our service management, we have to address our production maintenance, our HSC security, admin services, and direct lifting costs. All these things must be addressed concurrently. What Nape is doing now is taking them one by one. We are focusing on the first 3. We have not dived into crude handling, and we're engaging the industry. We're collaborating to see how best we can. Whatever we can do in terms of collaborating and facility sharing, we're doing, and we're encouraging that. We're also looking at the logistics. Can we create corridors whereby we can have a one security corridor that we can minimize some of those things? Can we talk to our service contractor, the marine contractor, to see how best can they innovate and create a very low cost solution for our marine requirements? And then obviously our HR, we need to re-engineer our HR. Many times people associate addressing HR with job losses. There are so much HR costs that are beyond job losses. Obviously, when you're doing reorganization, there has to be some rationalization, or as many like to call it, right sizing, but they are more beyond the right sizing. You have to address your training costs. You have to address a new way of doing so many things. In Nape today, we are popularizing virtual training. We are reducing travel footprint, and we're doing so many other things that has significant impact. And we expect the industry to do the same thing. And that's what we are collaborating with, and that's what we're trying to do. Can we please go to the next slide? I just want to draw the attention of the industry to know that whatever we do, we cannot operate outside this nation. As they said, there will never be egg in a broken nest. The nest is the country, and the eggs are you and I, and the oil industry. And if we have to salvage industry, we must contextualize it in the context of wider Nigeria. If you look at the HR cost, just to give you an example and a context, national budget of Nigeria in 2020 are those numbers, about 11 trillion, precisely 10.8 trillion. What are our population? We assume 200 million people. And when you look at that, you now see how much the population of the workforce in the oil and gas industry. Our view is that we're about 50,000 or below. And that 50,000, you know, our total bill, our bill for HR is 785, almost 1 trillion. And what that means is that 7.3 of our wages, of our bill, HR costs, represents 7.3 of our total budget as a nation. And who is consuming this? Is the 50,000 of us that we're consuming that. This is the reality. These are numbers. These are facts. The question is, are these sustainable? And I think we should be able to answer that. So if you go by Pareto, like I said, we have been, HR is a big one that we can't ignore. We must address it, but we must address it carefully and making sure that we don't cause any disruption. And I think that's what the industry is collaborating to do. And in doing that is to be smart, to make sure that whatever we're doing can stand the test of whatever that will help us to achieve our national objective. We're conscious we have social responsibility, but we're also conscious that we need to deliver money into the Federation. If we don't deliver the money, it's going to create instability. And if we have instability, nobody will have the freedom and license to operate in the oil and gas space. So it's compelling. It's in our informed self-best interest to work together to address this cause so that we can underpin and have a sustainable industry. Can we go to the next slide? If we do that, obviously we're going to end up with a good benefit. But what is Nape doing is what we are doing as an industry. As you know, Napes operate through our operators and contractors. And for us, our critical stakeholders from the operating perspective must be made sustainable. Our operators or contractors under the PSC and the service providers, ranging from rig providers all the way to facility, construction project managers, whatever that you have, we need to collaborate. If we collaborate, we can save the industry. And then we'll be able to return value to our shareholders. And to do that, Rogers and Co. talk about contracting cycle. It's something that we create deliberately by ourselves, by our self-interest and the way we run our contracts. We are addressing that, we are streamlining that, we are putting a framework that we ensure less than 6 months. The target I've been given is 6 months, but we've seen opportunity. We're working with the industry on OPTS. We think we can achieve some of the contract at below 6 months, actually between 3 to 4 months, some of them. We are working on that. Very soon, Napins, in collaboration with the industry, will come out with a roadmap and framework that will make sure that we achieve that. But meanwhile, we're already implementing some of the measures. Today, we are able to turn some contract in less than 6 months, and there are some that we do in about 7 to 8 months. Our great majority still take more than 1 year. We think we can turn the hand of the clock after we launch our new framework. There's what Nape has introduced, what we call the inside-out strategy. We do know that our operators are doing the best they can, but we also know that whatever they are going to do, they have to be able to get some good feedback. There's no better institution to give them feedback than the non-operating partners, because we understand the business and we need to give them our own viewpoint. Not only to give them our viewpoint, our points that we think that they should focus on, so that together we can achieve our collective aspiration, something that is of common objectives. So the inside-out strategy just focus on basic of business review. We review our operators' performance. As soon as we do that, obviously we see some of the weak points, and then those weak points become opportunity. And there are 2 opportunities that we seek to identify when to do our inside-out strategy. Basically, we look at opportunity gaps and we look at performance gaps, and we generate what we think from non-operating perspective could be a strategy that could close those gaps. And then we take it outside into the business, into the operator's kitchen. We sit down with them, we debate it, we get some alignment. Once we get some alignment, we achieve first, we agree that we have some of those gaps. We agree on high level of what is to be done. And then using their operating or contracting positions, they will take it and do the needful. The needful means they will go and do the work program, and they will propose a budget. And then we'll look at the budget and address the budget. And when it is done, we do know that it's going to create value, and then we'll continue to monitor and ensure that that value is created. That's all about the IOS. Again, the industry will come to know more and more about it. And Napins is also popularizing, is championing to the delight of the industry, what we call virtual works activities. We're doing a lot of remote activities, and we're collaborating with some of our big brothers, our regulators, NCDMB and DPR, to see how we can perform some of the statutory function without physical presence. The reason why we have to do that is for our own health, our own safety, but most importantly, in order to reduce costs. And so when we collaborate, certain things that we can do, like factory acceptance tests, which I must thank DPR. DPR is already ahead of everybody in the industry in trying to popularize this. And I must thank the leadership of DPR for doing that. We're also talking to NCDMB, who are doing some good initiatives, and then put this together with the industry. We should be able to reduce significant component of physical activities. We should do it virtual or a hybrid at best. We are also doing portfolio balancing. In our portfolio balancing, for now, we are focusing on what we are producing. As you know, the hydrocarbon fuel is made up of oil, gas, and condensate. Our revenue has been too oily. We are so much exposed on oil. So the recent dynamic that we've been told, and the mandate given to us by the president, can you rebalance your revenue portfolio? The intent is very simple. The more diversified our portfolio is in terms of revenue, the more our ability to be resilient and to stand the shock of any impact on one commodity. Otherwise, if oil is constituting about 90% of our revenue, then we're in trouble. So we are focusing on making sure that we optimize gas. We're no longer going to be approving anybody that will generate gas without monetizing it. If you are coming with a development, you have to come with an integrated solution, how you are going to utilize it. Of course, if we don't do that, we pay penalty. And DPR, I think, has made the incentive so high, or the disincentive rather, for us to do what we need to do right. The clear penalty is very high, and Nape is not going to support the payment of any penalty, particularly on new development. On all development, we're already working with the team to make sure that any significant gas volume, we're trying to monetize it. And we're bringing in third party, we're monitoring, collaborating with third party to make sure that that is done. We are also trying to extract condensate and make them a standalone, but even we are going to focus FIDs on some condensate specific volume. Because condensate is outside the OPEC cut, that means we have ability to produce, to market that. So if we can have an increased revenue from condensate footprint, we can increase our gas revenue footprint. It means it can dilute to some reasonable extent our oil exposure. And that's the item, that's what we mean by the diversification that we're working on. Obviously, we're optimizing gas, I did mention that. We're trying to create in-country combustion. We're using it as catalyst for national development, and we're trying to make sure that we use it for petrochemicals, which we think is a good thing to go, in addition, obviously, to power that we're all focused on. The AKK that is going there is meant to basically increase the footprint for the gas utilization, particularly for power and for chemicals. And then we are also trying to see if we can provide incentives to whoever that will champion cost reduction. So we're working with the industry. Anybody that will have an ability to be cost prudent, we're going to be awarding him maybe something close to what we call a good award of recognition, but beyond that, there's going to be some incentives. We're working on those other incentives. All these are geared toward creating collaboration so that we can together make this a sustainable industry. Can we go to the next slide? And the next slide is just focusing that if we are able to achieve this, what will be the gain? It's a collective gain by all of us. The oil and gas industry will be happier for it. The service industry will have more and more jobs. They will turn their workforce and they will have sustainable revenue. And they can continue to grow and even grow beyond the shore of Nigeria. The investors will have money to continue to be incentivized to invest more and more. And obviously government will have money that will continue to underpin the survival of this country. As you are aware, the oil and gas industry play a critical role in ensuring the financial security and energy security of this country. And so if we are able to get this, that's a big gain. And if the country is stable, we have stable financial security, and we have energy security, it therefore means the oil and gas industry will be better for it. So again, the emphasis is, it is in our own informed self-interest to be sure that, to make sure that we achieve a low UOC environment. Can we go to the next slide? And the next slide is just basically to leave some conclusion. Yes, we've seen the devastating impact of the COVID. And I think what this does actually is brought about opportunity for us to rethink and reshape and think our strategy going forward. And we're doing a lot of engineering, be it from production architecture, from hydrocarbon accounting architecture, financial engineering, hedging instrumentation, and all kinds of innovation and creativity are happening, courtesy of the COVID. We're changing our work practices to reflect on 21st century reality. Oil demand, we know that is going to be challenged, and there are going to be deterioration. And therefore, keeping your market is key. But not only keeping your market, whatever you can have a low carbon footprint, it can go a long way. So we're going to diversify and make sure that whatever we do, we achieve what we need to achieve in terms of our target of oil and gas production. The upstream investment we know is challenged, and therefore we need to be more creative to ensure that we attract capital into this industry. As you are aware, and you have listened to Rogers, the industry is challenged in different perspectives. But we know our challenges, that's the beauty about it. And once you know your challenges and you can convert these challenges to opportunities, you discover that you're already in a trajectory of improving our prosperity. And I think we are ready again to collaborate with the industry to achieve that. Our key drivers has been identified, and we have done some certain initiatives, and we are seeing some benefit of that. HR, logistic, and direct lifting. Today we have shaved at least between $2 to $3 out of unit cost of operation from where we closed the 2019, and we are continuing. and continuing to make sure that we achieve lower than $10 USD. But not only lower than $10, we're also going to be collaborating with the industry to reduce our capex cost. If we can reduce our cost of capital expenditure, that will also go a long way. Ultimately, our UTC will be low, and we'll all be good for it. So if there's any one message, because Abdulatif asked me, what one message will I leave the industry with? The message is that achieving a lower cost of production is not a luxury. It's not a desire. It's a must do if this industry must remain sustainable. Thank you very much for the opportunity. Thank you, Nape, for the good work you are doing for the industry and for Nigeria. I do appreciate this, and I thank you for the opportunity once again. Thank you.
Okay. Where do we start from? Thank you, sir. We really appreciate your contribution so far. We are significantly way behind time, but it still doesn't. We still have to address a couple of things. You have mentioned so many things and specific items you would like to drive down. But the real question, and it will just be one question, is this. Collaborating or in cooperation with other regulators of the industry, what specific actions are you carrying out to ensure that cost elements that pertain to what you have direct oversight on are being reduced to reflect the new target of a $10 per barrel, or a significantly increase and optimize lower OPEX and CAPEX? What specific actions are you carrying out in collaboration with regulators of the industry, sir?
I did mention, maybe I'm not clear. There's what they call factory acceptance test. Anytime you are doing factory acceptance test, you go to America, Japan, wherever to inspect a compressor. Depending on who you are, you take between 5 to 10 people into Japan. And because, unlike me in Nape, I can fly economy, in the operator circuit, it has to be business class. I do not know what is the cost of ticket for business class, but even if I assume a conservative number of $10,000, it means just cost of flight ticket alone for an average of 7 people is $70,000. That gentleman or woman that went there, they must stay in the hotel. They would get their per diems. If you take an average of per diem of $500, times the number of times Abdulatif, how you have a calculator and you're calculating. What you come across, we see the cost of factory acceptance tests ranging between $200,000 to $250,000. Do you know how many compressors we're ordering in this country every year? Do you know how many factory acceptance tests we're doing every year? Aggregate these numbers, and then you'll see what we are talking about. And that's why I'm so happy through our collaboration, and DPR is actually ahead of us in this. I must thank my brother Awal. Under his leadership, he has brought down that we can do what we call remote factory acceptance test. He's investing so much money to create development that, except where absolutely necessary, will reduce our footprint. To do so many of that remotely, if you do that, you can reduce that number significantly. And like I said, we do blame DPR, but absolutely DPR are ahead of us. So actually, DPR is putting on our toes. Hey guys, this is an opportunity to reduce your costs. Take advantage of my platform. Do what you need to do so that you can bring down. So it's a challenge for all of us, the operators. And NAPIMS will surely champion that. That's number one.
Thank you.
Number two, we do know, and everybody knows. We know, I must tell you this. We know of a company, a big company, I don't need to call it name. Once upon a time, it does 600 million barrels of 600,000 barrel of production. Today, they are doing less than 200. Their staff footprints remain the way they were. Their vessel requirement has gone north. Their cost has gone north. The barrel has come down. Price has come down. The question is, how sustainable is that? How sustainable is that? Production number in the country has come down significantly, but cost has gone up. We know our production losses are getting higher and higher. We talk about technology. We are now deploying technology to do so many things. We are working with the industry to deploy drones. And all we are trying to do is to get regulatory approval on some of those things. As soon as we get it, we got into that place, and then we'll reduce costs. So there are quite a number of significant effort that is being done, that we are able to achieve a $2, $3 savings just between January and today. Actually, between April and today, it shows that there are cost reduction opportunity in the industry. And I do know that one industry that we have not tapped, industry player that we have not tapped, they are the service providers. They hold the S, the very critical success factor. We will contact them, but we'll contact them as a team so that we will all work together to co-create solution. We're going to partner with them, to collaborate with them, to co-create a solution that will ensure sustainability. We don't want them to go down, and so they don't want the industry to go down. And if we don't want the industry to go down, we must take one common enemy, that is cost. If we don't take cost down, cost will take us down. It's not an option. It's something that must be done, Abdul Latif. And I think that is the message that Nape would like to leave Nape with. Thank you.
Thank you very, very much. It's always good when we see significant alignment in the industry. When everybody's focused on the same goal, I believe success is something we cannot miss. And the fact that you're having conversations across the industry with DPR and other regulators shows that we're all taking this seriously. We want to remove duplicity of cost or fees or any things of that nature. We want to reduce redundancy, leverage digital technologies to reduce costs, even if it's remote evaluation, like you said, the factory acceptance tests and things of that nature. Again, what can I say? The GGM NAPIMS is clearly very passionate about this. The conversation will continue. And we're going to take a very, very short break now, and then we'll go on with our speakers. Again, thank you very much, GGM NAPIMS, Balam M. Munti. It was a pleasure to have you, sir. Let's have a short break, please.
Thank you for the opportunity. Can I?
The world. And once you have that glut situation, where you have overproduction, oversupply, any name you call it, it affects your prices, because once demand goes down, prices go down. And we have never seen anything like this, prices collapsing to as low as $13 at a point in time. In a day, there's a point in time where price of crude oil, for the first time, the Brent came down to $13 to the barrel. And beyond that, many countries responded differently. Most oil producing countries decided to actually discount their crude so that they can sell the backlog of production that they have. And what that meant is that at a point, we are selling our crude oil at below $10 to the barrel. And in some jurisdictions, particularly where heavy oil is produced in Canada, we have a situation where people are given a check to come and pick crude oil for about a week's period or so. That has happened. What it means is that, you are producing oil, you are actually, in Nigerian parlance, you are dashing people oil. And that isn't sustainable. And of course, the industry was obviously heading for a crash. And where do you see, even though there's expectation from all of us that pandemic lockdown and economic slowdown will not be forever, but our business is so complex and so reactive that what you see is investments will go down. What the chart you see here is showing you how the collapse that we have seen in investment in the upstream in particular. And we have seen clear drop of up to 26% of investment opportunities in the upstream. And that's quite significant for our industry. The other part of it is for us as geoscientists, once the first casualty is exploration, that once prices go down, nobody will go into exploration. even for development drilling, if you look at the screen here in the United States where data is clear and recorded, you see the crash in rig counts in the United States. Over 446 rigs were dropped within the first 3 months of the year. And of course, we all know that the rigs, you don't just drop it and come back. So it will take you time to come back. So once there's a drop in rig count, it means that production will continue to decline. It is difficult to come back, but there's nobody to fund it. And the other collateral damages. This same situation has played out in very many jurisdictions. We are a bit resilient here. Despite this situation in this country, our rig count, even though it was not high in the first instance, but it did not just go down as dramatically as it is in the United States Gulf. So what did all this mean to the Nigerian economy? It created a situation of revenue instability for us. As you are all aware, there's a massive decline in revenue when your estimate is at $57 to the barrel, and then you ended off at the crude oil prices, below $13. Then you are in trouble. Then, of course, as that was going on, we needed to respond as a country, because the only way you can sell your volume so that you don't shut down is to reduce your prices. We decided to do a discount. In the market, it's called a discount, so that we can take out some value from the reference crude oil price. We took out as much as $4 to the barrel. That still didn't help. We still had cargo overhang. And the implication of that is it created some production uncertainties. We are not sure that production can go on. Our partners cannot continue to invest. We can see the visibility of a cash flow that will support the activities of the industries. And at the end of it all, it created huge production uncertainties. People cannot plan with us. And what every investor will do is to defer his investment under such situation. You don't have a cash flow. The banks will not lend you money because they cannot see visibility to your cash flow. And therefore, there are deferments of investment. We did it all across the industry. Every operating company has done it. And of course, we have some level of luck. We're able to take FID on some projects. But that's not what we wanted. That's not the level that we wanted. But that's the reality that we face. That means every company did some form of project deferment. And it also introduced project delivery risk. A number of projects can no longer be supported by the current cash flow situation. What it means is that there are significant risks on many projects. They may not be delivered within the time that we expect it to come by. So what does it really mean to the Nigerian state? Is this very important for us to understand? This country is dependent largely on crude oil revenue for budget support. Not because the GDP of this country depends on the oil and gas, but the actual cash flow comes directly from the oil and gas production and revenues, either in forms of taxes or royalties or direct revenues that come from NNPC, or even incidental revenues that are attached to oil production.
Okay, we're going to end our break now. Thank you so far. First thing first, we do need to apologize. We are way behind schedule, but the conversation has absolutely been worth it. A couple of issues have been raised, and those that we are quite familiar with, some new ones have been raised. But every time a speaker comes on, from the keynote speaker, from Rogers to Pedro, they have kept on talking about the same thing. There needs to be increased collaboration, increased collaboration, increased collaboration. So it is a pleasure of mine to introduce a very good friend of mine, actually, Engineer Chikeeze Nwosu. He has definitely been around the block, and the conversation that is going to be championed on the topic is improving cost efficiency through joint industry operations and shared services. This is clearly in the same position Roger and Pedro has stated earlier, the need for collaboration. Engineer Nwosu has about 3 decades of experience, local and international, in oil and gas upstream, from several companies. The list, I don't even want to list them all because everybody will claim ownership of this great man. Engineer Wosu, are you there? Can you hear me?
Yes, I'm here and I can hear you very well. Thank you.
All right. Because of time, I'll let you just go straight to it. It's good to have you here, sir.
Thank you very much. I'm assuming you have my slide pack.
Yes, sir.
Very good. Very good. Okay. So thank you very much, Nape. Again, an association I'm very proud of over many years. We're great friends there as well. Now, I'll try to save you as much time as I can.
Apologies,
because a lot of
just
great
speak up just a little more. Could you speak up just a little more if you don't mind?
Can you hear me very well now?
Yeah, we can, but it's just light. It's pretty.
Okay. I'm going to try and do my best.
Okay, sir.
I'm bringing the mic closer to me. Can you hear me very well now?
Yes, we can hear you very well, sir.
Okay, good. So I'm going to try and do as much justice to the part about joint industry operations and shared services, because the previous speakers have done a great job with respect to laying the strategic imperatives on why we need to go through this journey. So I'll try to save as much time as I can. And so let's go to the next slide immediately, which just gives, an outline of what I'm going to talk about. Next slide. Okay, so I will do very quickly on the strategic imperatives, the challenge of high oil cost countries, which has already been dealt with. And then I'll go into cost drivers and joint industrial operations and shared services, which is the main topic I want to focus on. Next slide. Okay. Both Roger, Pedro, and the GGM Nape have already set the scene for this. This is a picture taken around about a decade ago with respect to the operating cost per barrel across countries. And you can see where Nigeria sits in this whole picture, okay? Now, I will also show another picture to make the very clear case about why it's a strategic imperative to make sure that we do everything in this country to drive down both the unit operating cost and the unit development cost. So overall, the unit technical cost. Now it shows that Nigeria is a high cost producing country, oil producing country. And therefore, it cannot take advantage of, this cost of producing a barrel of oil when the oil price comes down. Even when the oil price goes up, typically what happens in our industry is that the cost of doing business also goes up. So whatever habits that we're going to address now are habits and behaviors that we hope will sustain even if the oil price goes up. Next slide. Now, this is another picture from CNN Money about what it costs to produce oil. And it's more or less in line with what the GGM Nape showed. If you look at Nigeria, it shows the capital expenditure in dollars per barrel in the darker color, and in the green color, the operating expenditure. And you're seeing levels of about $15, $16 each. And those are the ones that have to be brought down significantly. And if we don't do that, the next slide, if you go to the next slide, will show that we will not survive. So the next slide talks about the average Brent equivalent break-even price by region and terrain. And you can see where we operate. And the lower bars there, wherever we operate there, the lower end is not where Nigeria is. Nigeria is probably at the 70 percentile point or even higher in any of these bars in those terrains of operation. So once again, there's a difference in terrain, but it is also clear that whatever terrain we are in Nigeria, we are not low-cost producers in those terrains. And again, this has been emphasized over and over again by the former speakers. Next slide. Now, what I was very happy to see in the GGM Nape slide, and the reason why I was happy to see that was the fact that I was wondering, where is the data about what these cost drivers in Nigeria are? And because it was something very important to me, I started gathering data right from my previous companies. I tried to get as much data as possible in terms of what these OPEX drivers are in Nigeria. And it's surprising that the numbers are very similar to what the GGM Nape just showed. Now, he showed HR cost of about 38%, making up the OPEX cost. Now, I showed general and admin. He showed admin 1%. I took note of those numbers. So I show general and admin expenses of about 41%. Regulatory and statutory that we all seem to complain many times about is just about 10%. Can it come down? Yes, it can. With some of the things that were mentioned about, the DPR working on doing remote factory acceptance tests. We have seen that in action actually in the commissioning of a refinery, where DPR managed to, in this whole COVID pandemic, to support us remotely and 1 or 2 visits, which substantially brought down the cost of the regulatory and statutory requirements for that refinery. Roger talked about crude handling charges. There's quite a lot inside there. The reserve production charge, we have to be able to negotiate that down. DPR is working on doing that. And it also includes the fact that this reserve production charge, if we're not able to dewater before we actually put liquids into the pipeline, we're paying for, volumes of liquid that are not important to us in the larger scheme of things. So technology applications are important. Regulatory work is important to try and drive the crude handling charges down. And the last one is the field operations, which take up about 28%. And again, there are many areas where I'm now going to focus on in terms of joint operations and shared services to bring down that cost, both OPEX and later on I'll talk about CAPEX. So this is in a nutshell, is the strategic imperative. We know what these cost drivers are, and we know that we can focus on bringing them down. One of the things that the GGM NAPIMS noted, and it's exactly the same, is that 70% of these costs are in areas where joint operations and shared services can make a huge impact. So I'll now go into the main content of what my presentation is about. Next slide. So collaboration. We've been doing some work in IPPG, the Independent Petroleum Producers Group, together with McKinsey and Company. And I'd like to say that this is material that has been built jointly with them, and we'll continue working on this. Now, OPTS, which includes beyond the independents, the IOCs, also has a collaboration platform. Now, I want to explain what the typical levers to make sure that we can reduce these O&M costs are from the work we've done so far, and the journey forward in making sure that we can actualize some of these levers that are going to be presented here. The first lever is increased utilization. And it's about making sure that you don't have idle equipment. So increased utilization of equipment infrastructure by pooling of resources, or creating a need for fewer providers and less equipment through coordination. Now, let me explain that it doesn't mean that we're going to have a negative impact on the service industry. It simply means that we're going to force behaviors in the service industry that forces them, as we collaborate, that they also should collaborate. So instead of having 10 companies, each of them talking about supply vessels and going into contracts with separate independent companies, on supply vessels, we will pool this together. The vessel sharing from the point of view of the operators, and hopefully drive the right behaviors with respect to the service companies to pool their resources together in such a way that we can increase utilization of equipment. Yeah, nothing idle. So it includes vessel sharing and pooling, supply-based consolidation, helicopter sharing and pooling, and rig sharing. We'll come to that later on. Next slide. The second of these levers is to reduce the overhead costs. We need to reduce the need for overhead, transportation costs through coordination of schedules and activities. And this is particularly important where you have companies in the same area of operations. Now, in the area of operation for Waltersmith Petroman, we have Seplat and SPDC. So we can coordinate procurement schedules to reduce import ceilings. We can bundle procurement volumes together, and we can consolidate our supply base in such a way that in that area of operation, and there are so many of these kind of companies and groups in different areas of operation. So apart from a global independence issue in the country, there is also a requirement to focus on certain areas of operations where there are more than 2 or 3 operating companies there to be able to reduce the overhead costs for these things. And that will be a significant reduction in our O&M cost as well. Next slide. Next slide, please. Okay. The next lever, the third of these levers, 5 levers, is to reduce lead time. And again, is to minimize lead time by creating transparency on potential for local purchasing, reduce mobilization, demobilization time as well. So if you consider the fact that we can build a schedule, which includes O&M activities for 3, 4, 5 companies, then it is 1 mobilization for the contractor and 1 demobilization. Instead of having a situation where each of them is doing a mob-demob of different contractors for exactly the same kind of services. Now, it also means that in a sense, we'll have a collaboration platform where we can share inventory, bundle volumes to enable local presence. So we want the local participation in these services such that we can give them something that works on an economies of scale. We also want to be able to pool specialty vessels. So if we are able to integrate all these services amongst the different operators, then we will significantly reduce lead time. Too much time wasted, being annoyed, arguing, or praising yourself for successes, where you can focus on what is typically important to deliver on a lot of these services for operations and maintenance. Next slide. The 4th lever is about standardization. And it's not standardization across board. It's alignment on standards for low complexity activities or equipment. There are many low complexity, low technology casing sizes, certain hardware for completion of wells, certain bolts and nuts and valves and, all these sort of things that can be standardized. And the idea of standardization here is that it makes sure that there are, certain routines across operators to enable us save money through best practices and economies of scale. So at a stage where we have an inventory that we're sharing, where I can look across and say, okay, we have standardized enough for me to say, this size of casing I need for the surface casing is available in Seplat's pool, is available in Niger Delta's pool, wherever it is, and they are not using it right now. And so I can shorten the so-called lead time for long lead items by being able to go to those inventories, which are already standardized, and make sure that I can utilize, some of the materials that they have there. So again, this is another lever to make sure that we can collaborate, joint sharing, and also reduce O&M costs. Next slide. The last of the levers is increased production efficiency, because everything you talk about with respect to costs, when we talk about unit costs, there is a cost element and then there's a production element as well. So we need to be able to increase uptime through increased flexibility and better coordination of activities and equipment usage. Now, part of it is also application of technology. So when we are talking about technology, let's not have disparate, research and development efforts or technology applications. I'll use this in my well. We don't know whether somebody else is using it in their own well to increase production efficiency. 2 key things. 1, if you pull these resources together, the service providers will reduce their costs to deliver those technologies. And two, you will then have the production efficiency that you require to increase your production and your productivity. And everybody benefits from this. There are also other areas where if you are jointly producing into a pipeline, for example, if you are collaborating and you understand at what injection points you're coming in, where losses, vandalization of equipment, you can actually pull your resources together to do proper surveillance of those lines. So again, you can increase your production efficiency, you can increase productivity by pulling services together. Inventory sharing again comes up, joint, simple maintenance teams. Why can't we have in the same area of operation the same maintenance teams? Why do we have to have our own individual maintenance teams? What's the reason for that? If we have standardized things, we have people that have the experience, then we can have joint, simple maintenance teams. And again, logistics pooling comes back again to increase flexibility. So these are the 5 levers that we're working on to see that we can drive joint industry operations and sharing of services to significantly reduce operation and maintenance costs. Next slide. So here we've done an estimate of the size of the prize. And this is targeted at these O&M collaboration synergies. And the idea behind this is to look at what we should focus on first. So low is the light gray round circle, high is the black circle. And we have not put numbers against this, but these are significant numbers in millions, if not tens of millions of dollars. So in terms of logistics, it's about joint security convoys, patrol coverage, shared aviation and land transportation, and pooled emergency responses. Now, if you take a look, you can see the order in which we have placed these, with the one we believe will deliver the highest value in terms of reduction of costs being the joint security convoys and patrol coverage. For supply chain management, as you've seen all across board, it is the shared inventory and warehousing. That provides a significant impact in terms of cost reduction if you can achieve that. And then there are other strategic areas. In the same areas of operations, you can have joint community relation activities. Why not? Why go and build a small, not world-class hospital where you can collaborate with other companies in that same area of operation and build a world-class hospital, one single world-class hospital? Yeah. So, and there are many other areas. GMOUs, you can bring all these GMOUs together. You can collaborate on delivering energy to the communities, road networks, whatever it is that the community's needs are. If you collaborate, you have more money within the purse and you make a major impact on the lives of those in your access and host communities as well. The shared cost of infrastructure is another important strategic one. Pipeline tie-ins, I mentioned that as well. Gathering stations. Why must everybody build their own flow station? Why? For example, in our own area of operation, we're processing NNPC and seplat crude, and it's working very well. And the cost of they're going to put, not just the ugliness in the landscape of having the landscape dotted with, so many gathering stations. I mean, when you look at offshore Nigeria, I look at it again and say, there must be an urban, development type of strategy that doesn't allow so many FPSOs littering the whole place. Are they to full capacity? Are they required? Can a larger FPSO save cost where you have a lot of other companies in the same vicinity of oil mining leases pulling together? So gathering stations, and again, this story about modular refineries, yeah? Again, we can dot them around the whole place, but we can also collaborate to grow their sizes in the same areas of operation. So those are some of the strategic levers that we can pull as well. Next slide. Okay, now this particular one focuses on capital project costs. And again, you can see how important it is. We've talked about O&M. So again, for these capital projects, there's a lot of long lead in terms of logistics, international shipping. We can have a joint shipping desk to coordinate and aggregate, incoming shipments from different companies. Why not? That will reduce costs. Supply chain, we can have farming on contracts, seismic acquisition, rig sharing, whatever it is. You can just continue to expand the scope. And I'll show an example with rig sharing, how this works where you can have farming contracts so that the contractor, the rig contractors or the conglomerate of rig contractors that come to do work here have enough scope to run their rigs for 2, 3, 4 years by having this kind of farming contracts. Joint contracting for projects. If we have similar projects ongoing, similar gas projects, similar oil projects, why can't we do joint contracting? Again, economies of scale. Bundled procurement, I've talked about that. Standardization, I've talked about that as well. And this also applies for capital project costs. Strategic, idea sharing, best practices. We should have a knowledge forum across all the independents and all the international oil companies where we can share best practices. Research and development collaboration, that one is very close to my heart. Each of the independents on their own cannot have the necessary funds to do any proper research and development collaboration in Nigeria. They have to be able to pull resources together. And if they pull resources together, then we can have impactful R&D collaboration with the universities, that's academia, and with the service industry, represented maybe by PETAN or other groups. And if we have these R&D collaborations at that scale, we will be able to move things. Instead of just adaptation of technology, we'll be able to start innovating our own indigenous technology. Joint capability building in terms of training, development activities, pool resources together. Don't send people abroad on trainings where you can actually pull these resources together, either do them virtually or do them in a group together with other companies so that you have large classroom sizes for these capability building. The other important part of that joint capability building is about sharing experiences, because it's not just about the formal learning. When people from disparate companies or disparate companies come together inside one classroom, they will be able to share their experiences and learnings and use that again to share best practices. And then finally, the one over and above all that we're saying strategically is to have government, ministerial, committee. They need to drive this cost reduction and contract cycle reductions as well. This has to be done. GGM Nape have spoken about it. When I say ministerial, I'm talking about all government agencies that are involved in anything that has to do with costs, contracting, contract cycles in the industry have to come together and make it clear that this is something that must be done. It's a must do, like GGM Nape said. It is not a nice to have. Next slide. This is my last but one slide. And basically, it's just an illustrative example that we're building on joint operations and shared services. And it shows you that, you can have different companies taking a look at when they will drill in blue, when the rig will be idle. And you have opportunities, the ones that are pointed out as opportunities, where other companies don't have to go through their own rig contracting cycle. They can simply farm into those same opportunities as well. And so we will need to build this for different shared services and joint operations. Projects, drilling, 3D data acquisition, look, whatever it is, we can build this kind of collaboration platforms. And that is the direction we're going forward on. Now, the last word that I'm going to say, and this is in conclusion. What is my company, Walter Smith Petroman, doing? We have a very strong collaboration with Seplat in so many areas, yeah? And because we're in the same area of operation, even our COVID response, our COVID-19 pandemic responses to the communities were done jointly for Imo State and our host communities as well. And that was great collaboration. We're collaborating on so many things in that area. We're looking at joint security operations. We're also looking at the road network to that entire area of operation because there are a lot of things happening there. Our refinery, the Seplat and the NNPC, AGPC gas plant, the Shell gas plant, our industrial complex that we're building. And therefore, there's a requirement to, as we build up that area of operation, have a new road that connects not the old Shell road that was there. That will not take this level of activities, but collaborate to build a new dual carriageway, concrete built 15 kilometers that joins the Port Harcourt to Owerri Express Road. And these are the areas of major collaboration that we can see going forward. So again, Nape, thank you very much for inviting me. I always enjoy speaking at these Nape sessions. And to the executive committee for always remembering me to bring me in here, I thank you very much. And to all the other speakers, for the wonderful work you have done. Thank you, and God bless all of you.
Thank you very much, Engineer Uwosu. Like I said, yeah, is it Shell? Is it ADAX? You've been everywhere. You've seen it upstream with the international oil companies. You've seen it with independents, and yeah, again with Walter Smith Petroman. The conversation around collaboration and the way you've dissected it is very, very interesting. My one question to you is this. It is clear that at the end of the day, we're trying to effectively reduce and optimize costs. But most of the companies have different operating philosophies. So from your experience, how do you merge, especially very diverse operating philosophies, to ensure at the end of the day, you have a win-win collaboration?
That's an excellent question. Excellent question. So fortunately for me, I've been in 3 oil and gas companies. And if there is one thread across all of them, is around cost optimization, reducing costs. So irrespective of the operation philosophies, there is that drive. And that's why in one of the levers I talked about, I said low complexity. Yeah. So irrespective of the operations philosophy or even for projects, whatever they are doing, there are low complexity aspects of the business we do. You know, we try sometimes to overcomplicate this oil and gas industry. Yeah. Smart wells, intelligent completions, all those kind of things. Well, let me tell you, it's a basic industry. It's digging hole and putting steel pipes in the ground to produce oil, and then putting more steel pipes on the surface, and a couple of valves and other pumps and things like that to export, process and export the crude. So there are low complexity areas that are the areas of targeted collaboration. That will not remove from whatever operations philosophy or projects philosophy, yeah, because you have philosophy around how to deliver projects that builds in whatever complexity the companies want to do. And I can tell you that in my estimation and from my experience, those common low complexity areas amount to about 30 or 40% of the overall content of these operations or projects. And therefore, if you can target that scope and significantly reduce costs, we'll be driving down towards below $10 per barrel operating cost.
Okay. Now, I gave everybody a parting shot, but in this case, I think it will be dual fold. So the first thing is NAPIMS is clearly positioned at driving down costs. The GMD, I think the 10th of June when we had him on our platform, that's when he announced the $10 per barrel target. So we see significant alignment. DPR has also been aligned, whether by the current pandemic. Everybody's aligned, lower cost. From your perspective, how do you address situations of duplicity? Because there seems to be a lot of areas where different organizations are effectively collecting the same thing. How are you addressing that?
Okay, I missed some part of it because you froze out. But I think you were talking about duplicity. Can you hear me very well?
Yes, I can hear you, sir. Let's talk about duplicity.
And that's where I talk about the tools we have to use. These are the collaboration platforms. So OPTS already has a collaboration platform, and IPPG is going to set up a collaboration platform. Let me explain the essence of this. There are certain antitrust rules that you have to obey with any of these collaboration platforms. However, if you're able to build these platforms around the different areas of operations or projects and whatever, and people are free to populate their activities inside there, then to a large extent, you will be able to, ensure that people are not duplicating efforts in terms of the areas where they are attempting to reduce costs. I also talked about knowledge sharing. It will be part of that platform so that you don't go and recreate the wheel. Yeah, you don't go and, let me use your words, duplicate the efforts. You can go and learn from what worked in the other company, do it, probably improve on it, and put it out there in the knowledge forum as well, so that other people can pick up. One of the things Roger said, which is very important, and I'll end with that. the entire Nigerian oil and gas industry has to start behaving like one company.
Yeah, I completely agree. So I said it was twofold. So you answered the, I'd say the operating part of the equation. Now the other part of the equation is duplication from the regulatory side. How are you providing feedback to the regulators that, hey, this institution and that organization or that agency or that department, you're all effectively charging me and asking for the same thing?
Yeah, that's actually, that's a very interesting one. This is what I refer to as a ministerial level committee on cost reduction. They should look across board. Yeah. So this is not something the industry will continue protesting, but look at the duplicity, and I like that word, of regulatory charges that are coming from different agencies. Even local governments have their own charge, state governments have their own charge. The federation has its own charge. Within the federation, different parastatals are charging for different things. There has to be a way of bringing all of them together. Yeah, looking across what it costs the industry, and the industry can start doing that work. We can actually start that work ourselves and put it in front of them and say, do something about this. Yeah, so there's a need for the industry to do the work to identify those areas where there are duplicitous costs coming from different government agencies, and take that forward to a ministerial committee level where this can be addressed. I'm assuming that it could be done under the auspices of the PIB when you have, when we go, because I think that effort is going on, when we have the, National Assembly sessions on the PIB, and some of these things will come up there. Yes, the public hearings, yes.
All right, thank you very, very much, Engineer Uwosu. And just to note, a couple of your engineer colleagues will not be happy with you because he said you just stick a pipe in the hole and just stick a pipe on the surface. Again, it is a pleasure to have you. Again, excellent conversation. We will continue to advance the conversation as we progress to the panel discussion. But before that, I'm going to be inviting the next speaker. Have a good day, sir, and thank you so much.
Thank you very much.
All right. So it's my pleasure to welcome the final speaker for today. She effectively is a member of Nape, more or less. She was a former vice president of Nape. She has over 3 decades of experience in oil and gas, the servicing space, operating space. She's currently the managing director for Asharami Energy, which is the upstream arm of the Sahara group of companies. And by my understanding, they just completed a well within this very, very, very complex and challenging environment. I welcome Mrs. Olajumoke Ajayi, Managing Director, Asharami Energy. She will be giving us a talk on local content participation in the Nigerian upstream, lowering barrier to entry. And hopefully she will give us some tricks and hints on how she successfully drilled a well in this environment, because few people are doing that right now. Good afternoon, ma'am. Over to you, ma'am. Okay, you're currently muted, ma'am. We would like you to unmute you.
Okay, good afternoon, everyone. Can you hear me?
Absolutely, absolutely.
All right. Okay. I feel honored to be here to talk on the topic local content participation in Nigerian upstream and how barriers to entry can be lowered. The fact that some of the points that I am about to mention have also come up in the previous presentations indicates that justice is being done by all the presenters on the subject matter. Next slide, please. Next slide, please. Next slide. Okay, so as you all know, the local content with reference to the Nigerian Oil and Gas Development Law of 2010 is about how much of local input, like money, men, materials, services, and ownership, go into the activities of the industry. This is aimed at creating and adding to the wealth of the nation by observing a high level of quality, health, and safety. Next slide, please. Okay, so before I go into the details of my presentation, I want us to look at the evolution of Nigerian oil industry. The Nigerian oil and gas industry dates back to 1908, when an evidence of mixed deposits was noticed during a mineral survey in Araromi in present-day Ondo State. As the interest for oil, Nigerian oil soared, so did the presence of IOCs, leaving marginal room for indigenous participation. In actual fact, foreign companies monopolized Nigerian oil and gas sector between 1958 and 1968. And in 1977, Nigerian National Petroleum Corporation, NNPC, was formed with a view of to regulating affairs in the Nigerian oil and gas industry. And Nigerian oil and gas companies, not having the requisite technology and expertise, joint venture with NNPC made up majority of the oil and gas projects as a means of injecting requisite expertise and technology. And come April 2010, the Nigerian Content Development Bill was passed. And this is to give more room for the participation of Nigerian companies in the oil and gas industry. And prime consideration was to be given to Nigerian operators and indigenous service providers in the allocation of all oil and gas block licenses. But despite the rapid growth that has been achieved in the Nigerian oil industry and subsequent wealth acquisition, there's still a huge shortfall in the required technological know-how in the sector. Next slide, please. So talking about, is that next slide? Okay, yeah. Talking about local content participation initiatives, a typical case study is the Marginal Oil Fields Program of year 2001. In consonance with the initiative aimed at encouraging local content participation, the Marginal Field Program was established in 2001. And under the program, 24 fields that had been underdeveloped for 10 years and above were withdrawn from IOCs by the federal government and reallocated to indigenous companies who demonstrated technical and financial capabilities in 2003. You'll be surprised that as at May 2016, a total of 30 marginal fields has been awarded, but only 9 had commenced production. So how come is this low performance of 30% despite these initiatives to boost indigenous participation? So the capital intensity associated with oil and gas development have hindered the realization of the objectives of the objectives set under the Marginal Field Program, as it has thrown up major funding challenges that indigenous participants have found overwhelming. It is not a surprise to me that some of these operators require such huge financial demand to take them to first oil. This is because I was privileged to have participated in the evaluation of more than 2/3 of the 24 marginal fields that were awarded in 2003. And my observation at that time was that while some of the fields allocated to some participants had on them wells that were in good conditions, good accessibility to the fields, and it requires minimal spending to get the field and to go first oil because of their proximity to existing facilities. Others were not so fortunate. For the less fortunate ones, the level of financing that would be required to enable them scale the hurdles was overwhelming. In actual fact, in the last, I think, 7 to 8 months, the licenses of 11 of the marginal fields operators were revoked for reasons of non-performance. For the success of the local content program, the government, for fairness, needs to review the unique cases of the non-performing participants in order to understand their situation and perhaps the impossibility of operating the fields successfully. It may then be found that in cases where the situation truly threatens non-profitability, the government can wade in to provide solution. Next slide, please. Now let's look at the individual challenges that plague indigenous operators. First on the list is financial limitation. The lack of accessibility to capital hinders indigenous companies from making the required investment to develop assets in comparison to foreign investors. Most indigenous operators are only able to raise enough fund of enough capital to acquire the fields. Additional finance needed to run operations are inaccessible. And Nigerian banks are disinclined to lending to marginal operators who present marginal fields itself as collateral. And without collateral by way of security, operations or opportunities for funding from Nigerian banks may not be readily available. Hence, the need to invite foreign partners becomes unavoidable. So banks are more predisposed to provide loans to indigenous operators who have substantial deposits sitting in the banks or who have cash flows from other businesses or other operations. So due to the challenges associated with obtaining financial aid from local banks, indigenous companies are forced to, at best, go into joint venture with other indigenous companies, or at worst, act as a surrogate for foreign companies, thereby defeating the local content objective. So we need to have strong energy banks that should be, we need to make that available to help provide funding for indigenous players in developing oil and gas projects, because access to funding at low interest rates will reduce the barrier that are reducing local content participation. So let's look at areas of operations. I know that Engineer Nwosu just mentioned a few of what I'm about to talk about. So in area of operations, a strategy that can help to reduce costs is to encourage project collaboration. So if indigenous companies come together, speak to service providers, and plan their work program in such a way that they can go together and tender for services. So long-term projects such as drilling campaigns can be jointly executed between two or more marginal operators by utilizing a shared contract with services. So long drilling campaigns are usually candidates for, as we all know, for better negotiation and discounts between the service provider and operator due to economies of scale. And since indigenous companies don't have excessive drilling campaigns due to limitations in financing, it presents an opportunity to collaborate with indigenous players by merging campaigns. This way, certain services are shared between operators and thereby driving down costs. And on the long run, this will result in driving down CAPEX costs borne by operators, and it allows for better cash flow management. And if you have operators, neighboring block, that has facilities that you can take advantage of. For instance, like Engineer Nwosu said, flow station, you don't need to build your own flow station. You can latch on that and just flow your crude there and have an agreement, CHA, with them. So next slide, please. So another challenge faced by indigenous operators are legal and policy limitations. And policy limitations to knowledge transfer. That's basically the one I want to focus on. The right legal and fiscal frameworks are required to adequately drive technological improvement and technological transfer in the Nigerian oil and gas space. While the Local Content Act touches on the need for technological transfer to Nigeria, specific laws are required to promote technological transfer. This can be achieved by ensuring that a certain percentage of research and development being performed by IOCs are carried out in Nigerian institutions to ensure adequate transfer of knowledge, thus certifying that the industry is educationally driven. Additionally, a strategy to boost indigenous participation could be in form of an inclusion in the contractual agreements between IOC and indigenous players during the divestment process. And this is to reflect the need for indigenous operators to work with IOCs for a certain transition period to facilitate an effective transfer of skill. This initiative has been proven to work in places like Norway, where IOCs were in joint teams with local companies for a period. Next slide, please. Okay, so another challenge still is the lack of infrastructure development. The country's inability to develop our infrastructure lies heavily in the fact that an iron and steel industrial base and effective machine tool manufacturing are unavailable. These underlying challenges must be addressed to make significant milestone in the participation of indigenous players. The Ajaokuta Steel Company was devised after the discovery of iron ore in commercial quantities in Nigeria. The steel company was built with a capacity to produce 1.3 million tons of steel a year. However, the company is presently in a failing state as all revival efforts have been unsuccessful. The oil and gas industry are heavily reliant on steel as a raw material in manufacturing several equipment that are utilized for operations, such as rigs, drilling pipes, tubulars, spare parts, equipment, and so on. So the revival of Ajaokuta Steel Base will encourage the fabrication of equipment that are critical to the upstream sector in Nigeria. This eliminates the need to procure long lead items and the cost associated with importing heavy-duty equipment. This will also serve as a game changer in reducing capital expenditure borne by indigenous operators, thereby lowering the barriers for increased indigenous participation and creating several job opportunities locally. So the next challenge can be found on slide 7. So let's go to slide 7. So here we talk about political and fiscal regime. Investors will always consider the impact of political and fiscal regime on their investment and its profitability. No one goes into a country or anywhere to invest without checking out what the fiscal regime says or what the political climate looks like in that country, in that environment. So it is very important. Once you get into the place, you must check what the political event looks like. You must check what their fiscal regime is. So let's look at the case of Nigeria with huge, for instance, if you have huge signature bonus to pay, the operator pays huge signature bonus and he acquires the field and not operate it because he has exhausted all their finances on entry fee. So the government can ensure convenient signature bonus to enable indigenous participants easily commence operations, achieve first oil, thereby facilitating early payment of royalty to the government, a payment that we all know will continue throughout the operating life of the assets. So if investors can be attracted with convenient signature bonus, will have sufficient money to start operation, and government will make money from the royalty on a, as long as the field is still producing, revenue is coming to the government in the area of royalty. Additionally, tax and also and fiscal regime should be sensitive to changing circumstances. So let's look at what obtains currently. Currently, royalties are paid yearly based on production volumes acquired from fields and assets. This has an impact on profitability of a company during low oil price regimes. So by restructuring royalty in a way that a certain percentage is linked to production volumes, while the remaining percentage is linked to profitability, it ensures that during low oil price regimes, the revenue stream is not completely negatively affected, as a royalty payment that is based on profitability will only be paid in periods of profitability. This is another way by which government can help attract indigenous investors. So in conclusion, which is my last slide, several initiatives have been introduced by Nigerian government to increase local content participation in Nigeria. As a result, some improvements have been recorded, most especially with marginal field program initiatives that facilitated the introduction of a lot of indigenous players into the oil and gas sector. The government must continually look at ways to improve policies and encourage investment into the oil and gas sector, as the need for the funding is paramount in increasing the rate of oil and gas development by indigenous players in this country. This would inevitably increase revenue to the country while attracting more independent participation. Sources of funding at low interest rate must be accessible to potential Nigerian investors. Additionally, the revival of the Ajaokuta Steel Company will transform the Nigerian oil and gas sector substantially. A functional steel base will serve as a critical step in helping to crash capex costs for operators within the Nigerian oil and gas space by encouraging increased indigenous participation while realizing other objectives of the Local Content Act. And finally, IOCs are known for training and developing employees' technical capacity. However, indigenous companies are not there yet, as they are preoccupied with reducing costs as a means of achieving profitability. Without the required training and technological transfer, certain skills that are required to maintain local participation may not be available, thus slowing down the growth of the local content participation. Indigenous players must categorize capacity building of employees as a priority in maintaining the required skills needed to sustain oil and gas development in Nigeria. Not to waste your time, I would like to stop at this point. Thank you very much.
All right, thank you very much, Madam Jumoke Ajayi, for your insight into the opportunities to effectively galvanize local content development in the country. Invariably, by having homegrown competence that will effectively drive down the costs. And I'm sure you've noticed 3 of our speakers has identified organization capability, personnel management, and human resources as one of the key levers and drivers or major cost elements in our operating expenses. So based on your presentation and your insight in the industry, at the end of the day, we are all in for, it's a business, we're all in for profitability. So the question to you is this: what is that middle road to ensure that we encourage local indigenous service providers and at the same time get the best of quality and standards at the most effective cost? How do we narrow that? What would be your suggestion, ma'am?
Okay, thank you very much. What I observed, we've been drilling wells like you mentioned earlier on. We are on our 3rd well this year. And as I'm speaking with you, we're about completing the 3rd well. So what I've observed is that local content initiative, what they do is the IOCs, the international service companies, still, go into partnership with the local companies. And by the time you bid for jobs, the cost is high because two companies will share the profit. So if we are sure that our local, service providers have the required knowledge, why don't we go to them directly? We don't need a middleman. And that is when we'll be able to drive down the cost and ensure that our services are carried out at favorable cost. Another thing, like I mentioned in my presentation, is that companies can come together. Companies in the same vicinity. You have one well campaign, you have two well campaigns, you have intervention job to be done. Come together and plan your work program in such a way that one person's project will not jeopardize the other person's project. Then you call the service provider and negotiate together and run your operations or your program or campaign on one, a shared contract. And by so doing, you can drive down costs. But most importantly, government should, I don't know how they will carry that out, but they should ensure that the service providers that are locals must they must ensure that they have the required knowledge, the required skills, so that we can depend on them and we don't need to go through, the IOCs to get local companies to do the jobs for us. With that, we'll drive out our OPEX as much as possible.
Okay, so then the next thing is, even with the best of intentions, at the end of the day, we cannot ignore that we do have a couple of outfits out there who have not delivered in terms of quality. So what would be your recommendations to NAPIMS, DPR, and other regulators in the industry to ensure that we filter out those companies that are not as competent and should not be playing in this space?
I think what needs to be done, because we can't joke with qualities. I think as much as we want local content, if the quality is not there, the business upstream company is not a 2 naira, 3 naira business. You talk in millions of dollars. So you have to ensure that the service providers know what they are doing. If there's anyone that has failed, operators should expose them. And NAPIMS should ensure that, or NIPEX should ensure that they are not registered on NIPEX portals. So you just have to make that. If you have, a scapegoat, and he goes, he experienced that, and every other person knows that, oh, this is the experience that this other service provider had, then everybody will sit up to ensure that they provide the required service.
Oh, excellent. I see where you're coming from. I believe once everybody knows the quality and standard of people's products and services, people will clearly decide which one they want to go for. Again, thank you, Madam Jumoke, for contributing to the conversation and on how best we can effectively reduce the Nigerian oil and gas production costs, especially within this new normal. I'm sure a lot of people will be looking forward to talking to you on how, when everybody is ramping down, you're drilling 3 wells within the pandemic. Again, thank you for joining us on the conversation today, and a lot of compliments to your company. Have a nice day, man.
Thank you very much.
All right. So we're now moving into, we're switching gears, as they say, into the next portion of the conversation. Right now, the plan is to move to the panel discussion portion of today's agenda, which will now wrap up the pre-conference workshop. A lot of salient, robust assessment, analysis, salient points have been put forward by a diverse group of speakers. The keynote speaker, Mr. Roger Brown, CEO, set the tone, and as you can see, we have not let down. Can we have the list of panel discussions, please? Okay, so without much ado, we are going to have a very robust discussion. We will invite all our panelists, all of them together. We're going to have Mr. Tony Akiosho, a publisher with African Oil and Gas. This is a man with almost 35 years of oil and gas experience and about equally the same in journalism. So he will be participating there. Mrs. Informa Okeke is a gas commercial analyst, economist with NAPIMS, and she'll be bringing our experience there. Prince Abagu will be representing, well, he'll be replacing Mr. Nosa Omoredion. He's divisional manager for Schlumberger Digital Integration for Nigeria. Mr. Nosa sends his apologies. Mr. Sherefada is a fellow of Nape, former vice president of Nape, founder of EMR, one of Nigeria's subsurface services company, will also be a member of the panel discussion. And Mr. Oge Peters, head of commercial Savannah Energy. I welcome the entire panelists to the conversation as we dive straight at it. Do we have all our panelists? Okay, Prince, welcome. It's been a while. It's good to see you.
Good to see you, Latif.
All right. Mr. Peters, welcome. Welcome to the discussion.
Thank you so much.
Okay. All right. As other panelists join us, I think I will start with Mr. Peters while Mr. Sherefada see Mr. Tony Akiosho and Mrs. Informa join us in the conversation. So in all the topics, as we start from Mr. Roger Brown all the way down, every now and then, especially the first three speakers, which includes the engine, not engineer Mosu. So I'm talking about Mr. Pedro, Mr. Brown, and they talk about gas.
Yes.
So, Mr. Peters, from your perspective, right, how do we effectively encourage gas commercialization? Because we're way behind where we should be. We all know we needed to support and drive energy in the country. But how do we at the same time drive that development, try to close that gap, and still keep costs and prices low, both OPEX and CAPEX?
It's funny, I think competition actually is ultimately what would really make the difference from the cost perspective. But I think there are three key areas. I'll round up with that. But the three key things that I think are required for gas commercialization and development. The first one I'd say would be on the fiscals and the incentive side. The second one would be on regulation, and then the third would be on financing. Those three critical areas. I think on the fiscals and regulation, I see, of course, in the proposed PID, royalty rates for gas have been reduced from 7% to about 5%, I believe, which is obviously very encouraging. I think that the elements of other fiscal regimes which might still need to be incorporated to actually make it a lot more compelling, because the opportunity cost of crude oil development is just so high, because of the liquidity, creditworthiness, and the currency mismatch. Even though the rates might be slightly, or the fiscals might be slightly more attractive, those other things I just mentioned might weigh into an upstream developer or producer deciding to drill an oil well versus a gas well. If I have, from a capital allocation perspective, as an upstream producer, if I got $20, am I going to spend that $20 to drill an oil well, sell it, get dollars, or am I going to take the $20 to do a gas well? So I know over time there's been fiscal regimes like the AGPA, which allow you to net off your capex for oil against gas. Of course, there were challenges with that, but I think ultimately anything that encourages gas development to be seen in a positive light. So that would be on the first point. On the second point, in terms of regulation, I think, and this touches a lot on the point about competition, because of course at the moment the grid-based power it utilizes up to 60 or so percent of upstream gas development so far for the domestic market. Of course, exports takes up quite a large percentage of the gas produced in Nigeria at the moment. So the focus obviously is on getting to that gas that's going to the domestic market is going for grid-based power. And of course, we all know the challenges sort of in the value chain, downstream distribution, etc. And of course, the availability of that electricity and power, which is generated from gas. So I think, of course, the pricing is regulated at the moment. Of course, the price of processed gas $2.50, and the price of transportation 80 cents. This is the grid-based power, and I think because the downstream pricing of electricity is such, and if we do what the equivalents are in terms of $1 per MMBTU, we're at that $10 to $12 per MMBTU now. But of course, because diesel self-generation, which is I'd say 90% of electricity generation in the country, is priced at what it is, about let's say 100 naira per kilowatt hour, etc., which is the equivalent of that $10 to $12 per MMBTU. I think you'd see that there's a lot of scope there from a pricing perspective. I think if because of course as an end consumer, you pay for what is guaranteed. So if the pricing, for example, I mean this might be potentially controversial, but if the pricing of gas, the value chain is structured in such a way that customers will take the most competitive pricing, then you could say there's a lot more scope to develop that market, both upstream, midstream, and downstream. But again, of course, this requires a lot of work to actually figure out what the net back pricing across the whole value chain that would make this work. But I think we shouldn't be afraid of market-driven, competitive, commercial pricing, because ultimately that's what is going to allow growth. Because distorted markets where there's a particular price but there's no supply shows that the demand-supply dynamics are not necessarily optimal. But of course, we can that is up for a lot of further debate. And finally, financing. Financing. Gas infrastructure. Gas is basically infrastructure, whether it be pipelines, processing capacity, etc. For again, this is for domestic market. This is really industrial development. It's a multiplier for the economy, right? And of course, key here is your currency. So you've got, from a gas perspective, you're looking at, you're making investments in dollars, looking to get returns over 20 plus years or so. But on the financing side, you've only got, on a corporate or project financing perspective, 5 to 7 year tenors with double-digit interest rates, both in dollars or naira. So it's very hard to essentially make gas development projects work on those sort of terms. So whether it be government or multilateral agencies, DFIs, etc., I think vehicles where we can get 20-year financing at concessionary rates for gas infrastructure and development projects would be extremely helpful. I think the gas infrastructure fund that proposed under the PID sounding like it's going in that direction. So I think that would be critical. So in summary, I think those three things would really move the needle in terms of gas development in Nigeria. Thank you so much.
Okay.
Unfortunately, I'm just about to board the flight, so I'm gonna have to drop off. So sorry about that, but I'd have loved to have engaged further in the discussion.
All right. If we don't get back to you, do have a safe flight. And thank you for your contribution so far.
Thank you so much for having me. Really
at the end. Okay. So a lot of the conversation so far, the focus is about how do we reduce costs? How do we reduce costs? We have a question which states, does cost reduction in oil and gas production affect market forces? Does a decrease in cost of production automatically imply a decrease in selling price of oil and gas products? So essentially, this is all around cost, but I think what I would add to that is an additional line. And that additional line is, how do we get into a situation where cost reduction is not just driven by the oil price, and it's not cyclical, so a drop in oil price does not translate to a drop in a reduction in cost, and then an increase in oil price does not result in an increase in cost. So I will start with you, Mr. Shaifa, and see your thoughts around how do we wean ourselves from a cost reduction approach that literally tracks the price of the barrel of oil. How do we get out of that fix?
Well, thank you, Lateef and Nape, for the invitation. I'd just like to, first of all, point out that I'm no more the executive director of Pillar Oil. I'm retired. I retired 2 years ago, so it's important that that's recognized that I'm coming from a position of retirement. Oil is a commodity, so basically it's traded internationally. Yeah, so you really, the price is dependent on market forces. The only place where you can have differences would be in the cost of products. And that's simply because when oil price goes down, the raw material for the products is cheaper. So naturally, the price of the products will come down. Now, as practitioners, I think, I believe a few of the speakers alluded to it, I think one of the key things we need as a country, because again, oil price is really not an oil industry problem alone. Listening to Mr. Wunti, it's a national problem because a lot of our income actually comes from there. So we need to understand this. So really, for us at this point, we need to begin to pivot slightly from producing crude, selling it, and collecting revenue to adding value to that crude. So that by the time you process your crude to an extent, you get the benefit of the low raw material price while selling your product before the price of the product comes down, because there's a lag time between the two. So that is a critical way of getting things out of that. The second thing which I'd like to again drift us into, which is not directly central in this question, is the fact that projections don't suggest that oil is heading back towards 100 or 80 in a hurry. So the sooner we get very serious about developing our gas resources, the better. I'll just like to close out by saying, like Chike has said, Engineer Wosu, oil production is just about putting pipes in there and connecting the pipes and getting a few valves and some processing equipment and pushing it away. Now the difference is this: gas business starts actually from the market. Gas processing is just a little bit, and management of gas projects is a bit more difficult and more challenging than oil projects. That's one. And refining is also very heavy on processing. And my own point would be, I'd just like to leave us all with something as I round this question up. How many greenfield, and I repeat, greenfield refinery and gas projects have come in on stream in Nigeria in the last 20 years? I repeat, greenfield. That tells us how challenging these projects are and how we have to really stay focused to be able to get value out of the industry. So that would be my own contribution. Thank you.
So before you get off, I'm trying to get you. So I see your responses and your approach has been very, very high level, but I'm trying to also, distill out specific pointers and actions that can help us currently reduce our production costs. I will still bounce back to Prince Agbago, but just some specific, one or two specific items that can really address that cost. Because yes, an integrated approach, full value chain integrated approach to especially focused on gas will bring more value for every dollar spent. We understand that. But how do we reduce that OPEX relatively and ensure that our space in Nigeria is competitive?
Well, I think a lot has been said about that, and I didn't want to repeat what anybody has said. But the reality, I'll just take two things that struck me. The first one was Pedro's presentation. And if you look at it, you will see the tracking of PIB uncertainty with investment trend. That itself tells you about the confidence in the industry. I think it is, I wrote something down here that any PIB we pass, I know Pedro thinks there's room for it, and there is room for improvement, but not passing the PIB is a bigger problem. It's a bigger problem, infinitely bigger, and that has to be done. So these little things are building up, erosion of confidence in our industry, and all these things lead to costs. The second thing I'll point out is that if you look at the GGM's presentation, those are just two things from presentations we've seen. You'll see that he says, admin costs, I think, or HR costs are the biggest costs. And I noticed that Chike also had, I think he called his own general and admin. But if you really look at the ranking of solutions that Chike has, you will immediately see that security is in there. So the point I'm making is that in those costs you see, in the background, security, crude vandalization, facility vandalization, these are big things that are really, really putting us under pressure. And some of those costs are coming out as if they're HR and admin costs, because those are areas where we really need to get serious. And again, that is not an all industry problem. It's a national problem. So this whole collaboration that we've been talking about is becoming more imperative for the survival of the country as a whole. So those are the sort of two things I would look at as big bucket items. Not having, our PIB and our regulation in place properly, and then the fact that, like Roger also pointed out, he didn't want to be very, disrespectful, but he said, well, it's not a very attractive investment, address. I think he called it a postcode. And the truth is that these are big costs. You want to take dollar loans, they're putting a premium of a few percentage items on your loan. So really, all these things need to be sorted out before we even start getting into the details of collaboration, which Chike has gone into in a big way, bringing in the service providers and giving them confidence so that they know they're in for the long term. There are also other things that I didn't want to repeat, like, joint usage of facilities. This is very important. We need to go into these sort of things. But again, I warn, apart from, and I say this all the time, apart from accountants and lawyers, and I know this is a public forum, but I'm retired, so it's wonderful. I can say anything I want. The reality is that Nigerians are not very great at working together. There's usually a bit too much suspicion and stuff like that. And you asked Chike that question. I can't remember how he answered it, but it is a genuine challenge. I mean, I have an asset next to Chike. Chike should produce it for me and give me my money, but I'm suspecting him. These are the challenges of business, and we have to get over this.
I think Chike is still on the line. You can probably chat him up after this. But thank you so much, sir.
All right, thank you.
Thank you so much.
I didn't want to repeat things.
I will distill one of those things because I want to make sure that the repertoire capture it. So one of the things I'm getting from you is that there are above ground impacts of our country around security, community issues, infrastructure, pipeline vandalization, infrastructure vandalization that you don't immediately see when you take a look at our cost elements, and it shows up as HR cost. So when you have like 5 security vessels, which in real means you have about 20 or 30 people on those vessels. So, it's a spread that keeps on piling up. But thank you very much. I'm coming to you, Prince, but before I do that, let me first welcome.
Sorry, just one last thing. It shows up as HR, admin, and logistics. And logistics. It's all under there.
Thank you, sir. So I'm going to first welcome Mrs. Okeke. Thank you for joining us, gas commercial analyst from Nape. So now, back to you, Prince. It's cost. And I'm sure you must have heard the GGM, Napins, mentioned that the one thing they need to bring into the fold of web to cut costs is a service provider. I do not know how you felt when he said that, but with what the service providers have been going through the last 2.5 years, we would really like to hear your take on that and the opportunities you see for us to reduce cost, and those specific levers you think we can tweak to reduce cost in Nigerian oil and gas production.
Thank you, Lateef, and good afternoon, everyone. So I think quite a lot has been said, and if we really put all the pieces together, we see that we do have issues that stem from sectors beyond our immediate industry, and Mr. Faraunshi did allude to that, and piggybacking on the comment around security mentioned by Engineer Chikemosu. Now, really, we are in an industry where we all have felt the heat of the crisis and the need for us to really push down costs. And I'm happy to see most of the analysis that has come out. The GGM of NAPIMS is the first time I'm seeing such statistics, and that's a good thing with really looking at data. The statistics that he's rolled out on where the components of the cost really today, I mean the large component is, and we look at the regulatory aspects, which I think it was Chike that touched on it, that it's just about 10%. If you put together all the lump sum regulatory associated costs. But then you have HR, logistics, handling, those 3 pillars, 70%. That's enormous. I think the next step would then be we try to break it down. What is a component of HR? What is a component of logistics? And as it were, for us in the servicing industry, we are not left out. We have to shipping stuff. We have to go through custom. Most of the equipment have to come from out of country. Those costs, someone has to pay for it. Effectively, it's a value chain that is connected. And if one person, if cost hits on one aspect of the value chain, somehow it trickles down because we're looking at a unit cost of a commodity. That same commodity is unique to everyone. So that cost is spread across. Now, I think if we need to really solve it, and good, we started talking about it. And from a service provider point of view, we've been having engagements with operators and indeed with NAPIMS, trying to look at how together we can, lend our voice to push down these costs. I take on one instance. What is our mindset? What is our behavioral mindset today when we hear of things around HR? The first thing that everyone thinks is, oh, people will lose jobs. That's not really the case. But then how effective and how efficient are we on utilization of our time in the industry? What is an average engineer, an average admin person doing in the 8 hours window he or she is supposed to contribute within a day? You find out that there's so much of repetitive task. And if we ask ourselves, do we really need to go through these repetitions in our various processes? Ideally, these are things that technology can fix. And again, a lot has been said, in different fora on the impact of technology and digitalization on helping us reduce the time people spend on processes. So that is one critical aspect. While we are trying to solve our inherent issues on security, we need to think about our mindset. Can we make that shift in our mind on how we would really be effective on utilizing the time of our people? And another statistics that was rolled out is that we have 40 years, pretty much, of reserves consumption left or production left. What are we doing to increase the reserve replacement ratio? The people who should spend time on doing more of these aspects perhaps are wallowing in repetitive tasks that simple automation or machine learning could have done. So that then brings back the essence of partnerships, collaboration, and Chike did a fantastic job enumerating what we can do. So I think we all need to have all the stakeholders sit down, leverage on best practices, leverage on workflows across the value chain that can help us be more efficient. Because I think if we can drive efficiency, there are things that are within our control within the industry. There are things that are not within our control. Security, there's a blank budget on security today. Even from a service provider standpoint, you don't have any fixed budget, because once there is anything goes wrong, you have to spend, and to make sure that there is safety of people, safety of equipment, and that processes can progress without disruption. So those within our control requires us to change our mindset, requires us to sit down, analyze the issues, look at each of those pillars and try to break it down and look at components that we can begin to fix internally from our little silos, and then bring all that experience and all that knowledge together in a way that will help us find solutions. Now, again, maybe one last thing before I drop off on this question. We cannot move forward without the right policy and framework. I think someone had mentioned that. Everybody is doing their bit today, but then I expect that there needs to be a policy and framework that helps us pull into that common objective in a manner. If we talk, for example, investment in infrastructure. I'm a service provider on data, on other aspects of data. If I need to solve your data issues today, you have to buy servers. A server is very expensive. In this nation, with the volume of operators we have, we should be thinking about an in-country cloud server. And that saves cost. Everyone shouldn't be ordering stuff, buying everything. If we have an in-country cloud server, we have that comfort feeling that indeed our data is secured, is within, in quote, because we know where our data is when we email it by Yahoo or by Gmail. So we need to start looking at all those things that one person cannot fix. And that's what regulation can really help us achieve. I just leave it there for now. Latif, thank you. Latif, you're mute.
Thank you very much. First, thank you, Prince, for your submission so far. Clearly, and well, you are the divisional manager for Sustainable Digital and Integration. You've highlighted where technology can increase efficiency and opportunities where the technology combined with collaboration can effectively reduce costs. And your last example really brings that home. Now, to Mrs. Okeke, thank you for joining us. Please help us pick up, and I want to tie that. Can you hear me?
Yes, I can.
Okay, excellent.
Good afternoon. Yeah.
Good afternoon. So what I want us to do right now is to address the PIB conversation, and that has been raised earlier. We had an excellent presentation by Mr. Pedro Omotuenyi of a partner and energy utilities leader in PwC. Now, at the end of the day, irrespective of the content of the bill, a lot of talk has been about the uncertainty that arises for it not being put into law yet. From your perspective, right, what can we do in this current space that we are with the uncertainty? Because a couple of years ago, we were told it was going to be passed next year or in 2 years' time. Then it moved. And we've been doing that since 2000. It's almost 20 years. If that was a kid, the kid would be rounding up university as we speak. So let's assume we kick the ball forward some more. How do you, what would you suggest to especially to operators and service companies in this space? How do we plan with this uncertainty?
Okay, thank you very much. The thing about uncertainty is that once it persists for too long, you find out that there will be loss in confidence. So it gets to the extent whereby people are no more interested to an extent in what you have to bring again, because they will keep kind of saying that if for the past 20 years we have been on this, and it's the same whole story going forward, then it might still be the same story for a very long time. So that being said, for us to continue to be a going concern as businesses, for us to continue to meet our different mandates in ensuring that we explore and produce in a profitable manner, every company has to look inwards to see the current status, the current policies that we have, the current tax regime that we have, the current strategies that have been put in place, and the current infrastructures that we have as a country in the upstream, midstream, and downstream oil and gas industry. How do we ensure that we utilize all of this to keep being profitable in our different business spaces? So the only thing that we can do, or amongst the many things that have been discussed that we can do, apart from collaboration, is to manage our resources efficiently. The role of efficiency, both in cost, in process management, in time management, cannot be overestimated. In fact, it cannot be overemphasized at the same time. So as a country and as businesses, we must at every given point in time look at our processes. What can we do better? How do we optimize, right? So for like I am in the gas space specifically. And so what we have done over these years, we know that gas is an incidental hydrocarbon. We're all out searching for oil. And so gas came. And in the process of that, initially we felt that gas was a nuisance. And so the profitability of gas was not harnessed until recently, very recently. And so what we are doing in the gas space, despite the challenges we're having in terms of infrastructure, because gas business requires infrastructure for you to be able to reduce your unit operating costs. But despite all of those challenges, what we try to do is to leverage on power. So we have gas to power, and gas to power is quite also challenged because we know that the kind of issues and challenges that we have in the gas value chain. So, but what we have done is collaborate with the power customers what are the things that we can do right now to ensure that we unlock the benefits in the gas business? And so what we are doing is, rather than wait until the time when we have these novel agreements and you are taking over 100 million scof of gas at the same time, can you take 2,000 scof of gas? Can you take 2 million scof of gas? Can you utilize that in the short term to produce what amount of power you can produce and put into the national grid? Okay, in paying me back, because in gas business, it's only when value is generated downstream that the upstream gets its own value. So in paying me back, is it possible that I leverage on your payment cycle with MBET? So whenever MBET is able to pay you, and they always pay anyway, it could take a longer time, it could take like 3 months, 6 months before they pay you. But whenever they pay you, I want it to be, to my agreement to be tied to your own agreement. So whenever you get that payment, you pay me back. So with this kind of little efforts on our own part, we have been able to unlock so many gas businesses in the Nigerian space. The same thing goes for gas-based industry, like the likes of Indorama. We have agreements with them where we sell gas, not so much volume, but little tickles of volumes, and at the end of the day, it now makes a huge impact, one way or the other, you know? So those are the kind of little things we are doing to ensure that in our own little space, despite the fact, the challenges we are having today, we collaborate with our customers, we collaborate with our off-takers, we collaborate at the same time with the different government parastatals to ensure that infrastructure is put in place and our gas is unlocked for the benefit of every player in the industry. So those are the kind of things we are doing.
So let me quickly jump into that, because one thing that you don't get from, well, one thing that you get from the entire conversation is this. Nigeria oil and gas industry is not in isolation. It is actually part of the bigger global upstream space. So with these opportunities you are trying to identify amongst the myriad of challenges, how competitive are you relatively? Are you taking a look at, okay, with these deals that we are striking on the 2 million score, 5 million score, how competitive are you? Because again, that will give an indication of how sustainable this approach will be or is.
Okay, so staying competitive is actually how you look at it in terms of your cost profile. In terms of, there's so many levers that you can look at if you want to stay competitive. And so for us in gas business, we have tried as much as possible to reduce our cost of operations. And like I said earlier, because gas is incidental, so the cost of producing gas, especially associated gas, is not as huge as the cost of producing oil or non-associated gas. So for that reason, we are quite competitive in that space, because if you look at the Nigerian gas market prices, it's stable. And with stability, you can do a lot of things, because with stability, you can forecast, you can project, and then you can also make a lot of decisions in terms of investment. But if you look, when you compare that with our export prices, the current normal, that is the COVID-19, greatly impacted on the prices we're getting from our exports. But however, when you look at the domestic market space and you look at the radar, you find out that those little volumes that we've been monetizing, we can greatly plan on our cash flow, because the international volatility and fluctuations in prices did not impact on it. So the gas to the different sectors in the Nigerian economy, the prices are still the same. There was no time anybody said, you're selling gas to me for $2. Please, can you bring it down to $1.50? It's still the same. And because there is a lot of potentials in country, a lot of potentials that have not been harnessed, if only this opportunity is given. And when I mean the opportunity in terms of infrastructure, and I know that the federal government is doing a lot. We have done the AKK, we are working on the AKK, the OBOB, OB3, and all of that. So by the time all of these infrastructures are put in place, I tell you, a lot of potentials reside in the domestic gas space. And that will be utilized. Like my GGM, Balawunti, showed you the statistics. We have more gas than we even have of crude, right?
Yes.
So yes, that's it. So it's a fact, you know. So, and then if we can harness this, he also showed you that by the time we are able to manage our flares, what we are flaring today can give us 5 megawatts of power. The same thing with the injection. So when these are short-time wins. When we are able to overcome all of this in the short time, in the past, we used to flare over 50% of our gas. Now we have reduced to 10%. We are going to like 1-2% of that. And by the time we get to that particular juncture, you find out that all those little efforts here and there that we have put in place to ensure that flare gas is monetized, we begin to have commensurate and big impact in the domestic market space and at large our profitability. So
I think before I let you go, the one thing I would like to ask you is, so Engineer Wosu shared this, Mr. Balawunti, the GGM Nape also shared this. When you look at your cost structure in the gas space, does it also show the same high HR service, logistics, and handling costs? Do you still have that as your biggest cost elements? I see you smiling.
So it's we're not, like you said earlier yourself, we're not in isolation, right? So it's the same companies. I must say that all the operators are integrated. So they have both oil and gas. So the likes of ExxonMobil and the likes of Shell, they are the ones still doing this exploration, right? So the cost, and it's the same resource base that they are using. So when I mean resource, in terms of both capital and both human capital, right? So it's the same resource base they are using. So yes, we find that cost profile quite high, but the good thing for gas is that it's not, like I said, it's not as volatile as oil. And so because you have removed that volatility, if you are able to manage your costs efficiently, then you can have, with your cash flow, you can project into the future, you can estimate, and at the same time, you can efficiently go into new greenfield projects. But the fundamental thing for us is to ensure that we utilize our gas in country.
Okay.
If we're able to do that, then we manage our profitability adequately. I think I should end there. Thank you.
All right. So I think I'm going to try to get Mr. Sheriff Adaonsi, fellow of Nape, back, and Prince, if I can get them back. So really, for me, what I would like to ask is around the HR perspective, the human resource perspective, and that element, because at the end of the day, 40% is phenomenal. And from the passion that the GGM shared with this, it is clearly out to take out that 40% at all costs. So my question and I'll start with Prince, in the servicing, oil and servicing space, do you also have costs that are reflective of about 40% on HR? Secondly, what are you guys doing? And I know you're going to talk about innovation, and we've already covered that. But what other levers are you tweaking? What specific actions are you carrying out to reduce your HR costs?
Okay, thanks, Latif. One thing, if there's anything we can learn from the times we're in, it's the importance of being very efficient on use of resources. When COVID came, we learned that we could do things differently. If you would compare one of the associated compensation costs, maybe around or not compensation, but costs associated with people, maybe travel, entertainment, you know. If you compare year on year, you would find that it has drastically reduced. I think I was listening to, trying to remember who, maybe the state governor, Sanwo-Olu, saying, you know, that he had done a couple of meetings with, you know, with the executive, and that he sees that there is value in utilization of virtual, you know, online meeting platforms, because it saves him the cost and the time of frequent trips to Abuja. Now, technology has sustained our ability to continuously innovate and our ability to also measure. Now, with the way cost is structured, and again, in the service industry, usually it's compensation, it's cost associated with, you know, all that people do. Trips, you know, hotels, those with the current realities we are in have significantly cut down. So we need to take the lessons that we have learned out of COVID into post-COVID. That trip that, you know, one is planning to make, is it necessary? And that's one of the things we do in oil and gas. We question ourselves. We have what is called journey management. The first principle of journey management is a trip necessary?
Yeah, is a trip necessary? Yeah.
So we need to step back and really look at what has been our lifestyle, what has been our practices. Are they really necessary? Are they essential to every component of our business? And we'll find that most of them really is no. So that alone will knock off a good percentage, because what happens is when we make some of this, when we engage on some of these processes, you know, not necessarily with the salary of employees, but with certain things that employees have to do. Go here, go there. In some of the, for example, today we want to fly to Benin. You probably need to fly to Abuja first before you able to go to Benin in the current environment. So is that trip really necessary? That's just one question. And if the trip is so essential, then you need to know that it has to be for exactly the optimal and the important, very pivotal aspect of the business. Otherwise, we are learning to leverage on platforms that can help us reduce costs, platforms that can help us in the process of reducing costs, ensure that our employees are effectively utilized. Today, we are measuring the utilization of the people. So how much productivity is the workforce bringing? We need to measure it. We have technology for that. And with that, you will ensure that people are effectively utilized, and that you enable them, equip them with tools that can help them to be more efficient. In that process, you gain ample amount of time that can be, you know, apportioned to other aspects of development, other aspects of engagement that are still very critical for the business. So in a nutshell, I think we've learned some things we've done. We've learned to leverage on platforms powered by technology. We've learned to measure. We need data. And that is one key thing that we've seen today. With data now, we have more visibility. We can see which buckets are really not helping these levers. And then we can start thinking strategy. What strategy can we put in place to help us drive quick wins, and as well create that structural roadmap that we can begin to tap into for the future. So those are some of the things that I can speak of from my own lenses, within the value chain. Thanks, Latif.
All All right, so let me put you on the spot, 30 seconds. How are you operating to support local content development?
Several, and I can tell you just one example I would give, or maybe two. Of my business is provisioning software for E&P workflows. Looking 2 years ago, actually, well, 2020 is just like a no year now, like a blank year, but then it's still part of our chronology, in terms of timing. When, for example, I started evaluating what is the challenge of our indigenous consultants in assessing software, I immediately saw the flag, cost. All right, and most of our indigenous consultants get projects valued 50K, 100K, and sometimes the software that they need to deliver on that project is probably more than half of the project value. So two issues. Number one, the value of the projects awarded to indigenous consultant is not substantial. For whatever reason, maybe the price low, or I don't know. Second issue, they are not able to, from the value of the contract awarded, address all the cost elements in their business. So what I did was to set up a platform, and I've shared this a few times I've organized a seminar for indigenous consultants. What I did was open up a center where you don't need to buy the software to own or even rent. You can, of course, before COVID, come in there, run your evaluation, and have your results delivered to your client. Within COVID, I put an e-concept to it, of course, electronic, where we can provision access for you to be able to do the same thing from the comfort of your office. So that again helped address one thing. It has not addressed it completely, but it's at least helping. When you cannot buy the original, you would easily default to the counterfeit. And that has been very prevalent in the industry. We have many consultants, they own the software, but it's not the original software. So we are trying to also help them and understand the challenge of using a counterfeit. You can never get credible results. The results will have some margin of error. Now, it may be negligible from your lens or from your point of view, but again, you deliver results that are suboptimal. If you are looking at a reserve or assets that have lifetime of 5, 10, 15, 20, 50 years, you solve the problem today by delivering your project, but you're in a business for 20 years. 10 years down the line, the operator wants to revisit the study and finds that every project, every result delivered was of no value. And that already kills reputation. So that's one thing. Collaboration with indigenous service companies, it's one other area, because we know that local content has come to stay. So we have opened up collaboration, platforms with indigenous companies to share best practices and also attend technology transfer, which we've also taken to the universities. Today, we have universities we are working with very closely on R&D. We've hit quite some successes with the University of Benin, who have been able to independently, with our mentoring, develop plugins for Petrel, Petrel plugins for certain G&G workflows. And this is one initiative that we are also working very closely with NCDMB on today. So I can speak of a few more, but these are key ones that I want to highlight.
Thank you very much. All right, thank you so much, Prince. Let me appreciate Prince for your time and the other panelists, if they're still there. Thank you, Mr. Sheriff Adamsi, a fellow of Nape, the founder of EMR, or co-founder of EMR, former executive director for Pillar Oil. And thank you, Prince Division Manager, Salombe J, Digital and Integration, Nigeria and West Africa. Thank you to Mrs. Ofoma Okeke, gas commercial economist at Napins. Now let me thank you. Let's invite our president-elect, or should we go for a break? I think our president-elect is excited. Let's have our president-elect directly. My president-elect, I hope you are happy so far with what we've.
I'm blown away. I am so blown away by what I have witnessed today. First of all, my immense thanks and gratitude to CEPLAT. They stepped in and they did a fantastic job in sponsoring this program. On behalf of NAPE, the executives and the members, I say thank you. The collaboration that we have received from our various stakeholders, the panelists, our employers, NAPE members, our partners, they are fantastic. I learned something today. My key takeaway today is that also, just to let you all know that everything we have said today is going to be collated. We have a fantastic team who are working behind the scenes to see that the communique is prepared tonight. Team, big ups to you. And as is the NAPE's usual practice, we are going to be publishing this communique in a national daily, and we are going to be delivering a copy of this to the highest ranking government official that will grace our opening ceremony. I really want to thank all the panelists again, the speakers, the moderators, and particularly the people who have been working this program takes off. Thanks and God bless you. This has been a fantastic event. It's gone way better than I ever dreamed or imagined. For all the technical shortcomings, please pardon us. This is our first time ever of having a virtual conference, and I'm sure we'll do better given the opportunity in future. Thank you very much and have a good day. Thank you.
Thank you, my president-elect. It's been a pleasure to be your master of ceremony and moderator for the day. Again, my name is Abdulatif Amodu, currently the publicity secretary for the Nigerian Association of Petroleum Explorationists. This is the first ever virtual international conference and exhibition. And we do have a lot more to share with you during the course of the week. Please stay tuned. If you've not registered, please do register. Tell a friend, tell a colleague. Anybody that's a stakeholder in our industry needs to be in this place. Note that even after the conference, you still have about 3 weeks where you can download some of the content which we'll be sharing with you live and across the different platforms within our NAPE conference app. Again, thank you for participating. I hope it has been worth your while and your time. Do have a great afternoon and a lovely day. Goodbye, everybody.